There.
Morning.
What up?
You guys hear me?
Yep. Morning, Will.
Okay, cool. How's it going? All right, give me 2 minutes. I'm gonna get started in just a minute. I'll just let the room fill up for a minute.
Cool.
Oh, can you guys hear me now? Okay, there we go. That's good.
Yep.
All right, cool. Yeah, I don't know what it is, man. Whenever I mute my mic here, for some reason, Zoom assumes that it needs to switch to another mic. They figure out how to stop that from happening. All right, we're gonna get through some charts. We're gonna talk about a few things up front, and then we'll get through some charts. I want to actually go through some TA today, guys. I want to show you guys some TA, show you how to look at charts and everything else. I think this helps with the FOMO, with the issues with understanding price moves and stuff like that. It can be difficult, right? A lot of people and I'm not saying they as in you guys. Well, some of you are a little bit eager to jump in at tops, but for the most part, I think I've shown you guys many times how that ends up resulting. I know it can be hard, but we got to remember this isn't a casino, right? It's your real hard-earned money, and that this is why I have these conversations with you guys. Again, I get nothing from this, guys, outside of teaching people. That's it. Like that's all I'm trying to do. I'm just trying to teach you guys. I don't ask you for anything. Some people donate, some people don't, which is okay. I mean, there's no difference between the people that do and the people that don't. What I want you guys to understand is all I'm trying to do is show you the manipulation that goes on in the market. And I don't mean manipulation by big money. I mean manipulation on how they condition your brain, right? They condition you to feel like if I don't get in now, I'm going to miss the opportunity of a lifetime. And it's just not true. It's never true. Because I could tell you, they told you guys that at 64K. They told you that at 60K. They told you at 50K. And Bitcoin could really, in reality, go all the way back, right? All the way, not even back. It could go all the way up to 100K. And I'm telling you, it'll more than likely go back below these previous tops. Even if it goes all the way 100K. Like the super cycle theory, all that's, it's all bullshit. This is a momentum game. And this is the way I play it, and this is why a lot of people have a hard time getting into it, because they don't understand that. They don't understand that these price movements are just their momentum. You create momentum to create liquidity. You push really hard to get everybody in, and then you sell into them. You have to understand that when price pushes, it's with the intention to create pressure. And that pressure is relieved by the same person that's pushing it. Now, what I mean by that is that person that's pushing price specifically is doing it with the intentions to create liquidity. They're doing it with the intentions to create FOMO. And you may be like, well, then that means I need to get in. No, it doesn't. You need to get in when people are fearful. Are people fearful at the highs? Anybody?
No.
All FOMO.
I don't know.
Euphoric.
I think yes, exactly, Erica. I think they are fearful, and I want to argue that in a sense that they're fearful due to euphoria, right? Whenever you're fearful due to euphoria, I feel good. This feels right. Hey, up and away forever. That's euphoria. Euphoria fear is bad. What kind of fear is good?
Blood on
Anyway.
the streets.
What's that?
Blood on the streets.
Blood on the streets. Hey, give me an example. Give me an example of that.
Probably just before this rally when
Yeah.
everything had slid and it sort of slid down again, and then it was just sort of tapering off downward, and everyone's like, oh, it's going to drop through again.
Look,
But-
scared. How many of you guys took action on these moves?
Yeah, that's where I took all mine on that one there.
Yeah, I could tell you, me and Tad's talked about this whole move all the way through here. Weren't buying up here. We weren't buying up here. And I'm not even saying like me and Tad's talk on a daily basis. He was just one of the few people in the group that were paying attention and listening. As I was grabbing alts and I was grabbing different things, I was like, go deeper. We could. But we're sitting here in a situation where this is a big flush. This looks very similar to this, right? So because this and this look very similar, people are thinking that this is going to happen again.
It's just a lack of volatility down at the bottom. It just wasn't. It's just
Yeah.
dead.
Yeah, when activity is low, okay, look, activity is low. Look, this is the highest they can push price. Look at it. And then it just literally just went like this. Activity was the lowest here. So whenever activity is low, expect for price to turn the other way. Look, right here. Activity is what? What do we see with activity there? Is there any volatility really?
It's just dwindling off.
This is dwindling off. When you start to see price move like this, you have to understand that there's going to be a reaction to no action. No action. Now, this is just looking at things from a TA perspective, right? It's not accounting for my bias on the economy. It's not accounting for my bias on the macro. It's just, it's a response that has to get an action that has to get a response, right? You have to get a response from that move. What are your two options here? Well, option one is it just keeps dwindling. Well, it's going to take a really long time to get lower, right? Option two is flip price up because nobody's willing to sell here and create more sellers, right? So you flip price up, get people super euphoric again, get them where they do not want to sell anymore. They want to hold, right? You got these holders, these buyers, this buying pressure, buy. Just hold to the moon straight up. And then I can tell you over here, you guys want me to show you what I saw all over Twitter and everywhere else? That's what I saw. What about everybody else? You know what I saw in the charts? That's what I saw. Do you see the difference in thought process here? This is what everybody's telling me. This is what I saw in the chart.
What did you see? The red is what everyone said, and then what did you see? What happened?
What happened?
Right.
Now, how did I
Read
see
to the
this? You guys want to know how I saw this? And I tell you guys this every time. One simple
Resistance?
indicator. One
round-
simple double top.
Rounding top.
You got rounding tops, right? Not only and I was kind of thinking this was how it would play out. I was like, okay, we got a round top, right? It just got a little blip in the middle, but it's still one big round top. Not only is it a round top, it's an M. So when they started coming back this way, I was like, oh, they're gonna do this. Where does an M break? It breaks at the neck, right? This wasn't gonna be a Head and Shoulders. I was like, they're gonna make it one massive M. Boom, 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 drop. This is why when everybody said no way in hell we're going below 30K. And I can tell you some of you from FS told me the same thing. You did tell me that, like, hey, this is not possible. Look, we got all the support here. We got all the support here. Look, we even supported right here. We're not going below 30K. And I understand the sentiment, but that's all it is. It's sentiment, right? The facts are they were creating an M here to go lower. And that's precisely what they did. Now, the thing is, they dropped price all the way down to here. Are there still gaps? Yeah, there's gaps all the way over here. So what should we expect from this? Well, everybody's expecting this, right? That's what they're expecting. But price doesn't move like that. Just like over here, everybody was expecting this. But what did price do? Went back
Support.
up, went back up, and then came down. What's price doing? Going back up. Everybody's getting euphoric. And I'm telling you, it's coming back down.
Will, how did you know that was gonna turn into an M? How did you know it didn't go back up? How was you know it was gonna keep going or turn into a W? Like, what made you know that was gonna be an M?
The resistance,
Higher
right?
high. Well, the resistance you should always watch 100%. Yeah, you don't even need the indicators for this. If you were looking at an indicator, that should have been only the RSI. What do you see right there?
Bearish divergence.
You get a bearish div. Now, some of you probably like, and I know you guys hear this word a lot, bearish div, right? And you're probably like, oh, I hear that a lot. Yeah, it doesn't mean anything. It does. Volume has to match previous euphoric zones to keep going. What does that mean? That means this high should have been equal to, if not higher than this high.
Momentum.
It's momentum. We did not have the same momentum over here that we had over here. So while everybody's going, oh, 150K, we're going to 600K. I saw people at $500,000. $500,000. And I was just like, there's no possibility that's going to happen. None. And I'm stupid. I'm dumb when I'm telling them it's going to top. I don't know what I'm talking about. Then comes the coping, right? The coping is, oh, it's 30K. 30K is the floor. 30K. It's not going to break 30K. Buy now and miss out. And I'll tell you, Bitboy said it. Everybody said it. Drop down. Boom. Oh, 20K is the floor. Never going below 20K. Never going below 20K. Never going below 20K. Boom. 15K. Oh, look, we got a bounce. Not coming back down. You missed out. You missed the bottom. Yada, yada. Now, keep in mind, we were calling buys, right, in here. And I think some of you were fearful. That's okay. I'm telling you, you're going to get another chance. And if you take the chance, then you'll be in. If you don't, then, you will miss what I would consider, potentially the bottom. If not, it's going to go deeper. This thing can get nasty. I'm telling you. I think if when people get fearful, it's time to buy, right? And right now, people aren't fearful; they're euphoric. So since and when I say fearful, again, we did talk about euphoria fear, right? But euphoria fear is not the same as fear. They're two different things. When people are fearful, that's your entry. It's always your entry. And the reality is the best case scenario that I can see is that we hold support here. Right? That's the best case scenario I see. Second best would be we revisit these lows. All right, into that 16K. Third best is price continues in a downtrend after they create this buying pressure that they could sell into, and we end up much deeper. These are kind of the three positions of buying that I'm seeing. Now I can tell you if you weren't willing to buy here, you probably won't buy here. And even if price comes here, you probably won't buy here. Does that make sense? Or is that confusing?
Makes
Well,
sense.
can I ask a question? Back to that M, the second top of that M. It's hard to see the RSI. Is it undersold? That's a bearish divergence on that second M?
It's not about, yeah. You mean overbought? Yeah, it's overbought.
So it's overbought. So when the second top of the M, the RSI was above 70, so it was overbought.
It has nothing to do with price. It has to do with where it lands on the RSI, right? So anything above the 50 becomes overbought. Anything
Right.
below the 50 becomes oversold. It has nothing to do with price. It's
No, I understand.
RSI is momentum. That's
I
what
got
it's
you. I don't-
strength. So a strong market, when intending to continue up on the second high, tends to want to be higher on volume, right? On strength. We're not seeing that on the RSI here. We were seeing a lower high. And now we're getting to the point where the market, what are we seeing right here? What are we seeing right here? Here, let's clear all this. What are we seeing right here on the RSI?
Higher high.
Oh, look at that. What are we seeing? Now this is higher than this move, but what are we seeing here?
Less momentum.
Far less momentum. These need to deviate the same way if the move is true. We got the RSI telling us one thing, and we got the chart telling us the other. Now, why did I draw this up here instead of underneath?
Because it's a trend is going up.
Nope. What's going on with our chart?
Bearish
It's
divergence.
pop.
It's a bearish div, so I drew a ceiling rather than drawing a support. This is how I look at bearish divs. When I see a bearish div, I draw a ceiling. When I see a bullish div, I draw a support. See the difference? Now we could even say, I wouldn't, this right here is not a bullish div. I do want you to understand that because price is already moving in this direction. A bullish div tends to happen when price is moving the opposite direction of strength, right? What you look for on a bullish div is you look for a reversal move. So that reversal move should have occurred from here to here. And then we were looking for this small build to break, right? Now that doesn't mean this. And this is what frustrates me so bad about people, right? It doesn't mean this. Like when you see charts like this, these people are idiots. straight up just don't understand market. Like I see this all the time. It's called engagement farming. That's
It's
what
click,
it is.
Yeah, clickbait. It's clickbait. That's all it is.
Yeah. They want to
Just
see
quick question.
and
I'm
they
sorry.
tip. Oh, no, you're good. You're good. What they're trying I go on their posts because I want to see what the low IQ people are saying, and I say that with all due respect, guys. Like I hate when people support this kind of stuff. It's just stupid. But they're like, "Oh, I love your optimistic approach." Okay, I'll just get on every day and I'll draw a chart like this for you guys. I'll post it and I'll just go, do whatever I do. Like, subscribe, give me money. So,
Quick question, Will.
yeah, go ahead.
Sorry.
No, you're good.
Do you tend to look for the bearish divergence and bullish divergence above 70 and below 30 on the RSI? Or does
Yeah,
that make any difference to you?
I'll be looking in on bigger time frames, right? So once price kind of shows its direction, I'll be looking for it. Now, one thing I'll definitely be looking at for it once we start kind of seeing that price round, right? So
yeah,
we always have to pay attention to our first pullback. Price ripped up to here, pulled back to here, we caught support. Where are we sitting?
It's becoming resistance now, right?
That's right. It's now becoming resistance.
And that matches up a lot. Well, one thing that concerned me too, that I lost a little bit of faith with the RSI divergence is that last push up. Whenever we moved, not the last push up, but the big push up previously.
This one?
Well, yeah, pretty much. I was watching the RSI on the smaller time frames, and it really threw me off. Like I kept seeing divergence, but it kept pushing on through, which I guess sentiment was carrying it on through. But
you have to keep in mind, and this is the hard part. The higher the time frame the div is, the more realistic it is. Right. So what are we seeing right here on the weekly? Right in here.
Yeah.
It was showing all the way up to the weekly. That means that price was really going to break. So smaller time frame divs don't really apply, right? So if you're looking at like 4 hour, 8 hour, daily, weekly, I mean, not daily, weekly, but 12 hour, if you're looking at anything below, I'd say a daily. And I would say even daily can throw you off. Why can daily throw you off? Because you could be playing this move, this move, this move, this move, like, oh, look at all these moves. And price is building. And then price builds, you buy into the move, boom, drops. And look, we got a bullish div right here in the daily, right? We got price dropping and then price dropping, and we're building. We're building with price. We got a solid hold right here across the bottom, and we're building momentum on the daily. But price still breaks. The true easiest move to follow here would have been following the weekly. And this is why I was using the weekly so much down here, because the higher time frames hold more significance than the lower time frames. And the weekly was spelling the same thing.
Things like the hourly could be influenced by the time different markets come online too.
Correct. Yeah. So like the New York and everything can shove right through certain deviations that you may see on the RSI versus others. So the higher the time frame, the more significant the move. And that's what I want you guys to really understand. Like you gotta stop looking at this and being like, well, if I look at it from the 4 hour perspective, I can make all this stuff look like this. You are not here to make the chart look how you want it to look. You are here to identify the patterns that are happening in a chart and how you should react to them. Right? This right here, the reaction move to this bearish div or bullish div is buy. This higher time frame move, I can tell you on the daily, I've got a bearish div, right? On the weekly, I have no formation of anything yet. If anything, on the weekly, this is a follow through move, which means that price is matching strength in a sense, right? Not quite the same. Not quite the same. And why would I say not quite the same? Because look at the strength on this move, and then look at the strength on this move. And it's almost an equal move, right? This is almost the same push here, but less strength. It is slowly losing momentum, but I don't have deviations on the weekly and higher. We'll say that was 228, right? And then this one right here, shoot, this thing flew all the way from down here, 47. So we'll say 47, and then we'll go with this one all the way up to the highest, 47. They're almost identical moves in low to high. You have clear manipulation and price right here. And that's what I was expecting when I was telling you guys 19K is where they would go, right? And I told you 19.6 was what I was looking for. If you look at price came all the way to 19,567. How much was I off? $33. I was $33 higher than where I thought prices are going to go, or where price went from where I thought it was going to go. That's a pretty good analysis. I'll tell you that, a really good one. Does that happen all the time? No, it doesn't. I'm not even going to lie to you guys. It just doesn't. But you have to identify where price can go. And one thing that you always have to pay attention to is, where was support? What do you see with price right there? What did they do from the consolidation here to the drop to the move? Somebody explain to me what they see there.
Was it that hammer?
Well, let's not look at the candle specifically. Just
They
tell me
stayed
what
on-
you see with price movement.
They stayed on that trend.
They stayed on the trend.
But they
So-
didn't come all the way to it though, right?
No. So I'm going to
They
explain
did.
it. So they consolidated here, and
Yeah,
again,
it's
what do we-
teriyaki rats in there.
what's that?
Did
Yeah,
you have
mute
anything?
Hold on one second. I think people are. If you guys want to unmute, feel free. I'm just going to mute everybody. You guys going to mute if you want though. Let me just grab everybody real quick. All right. You can unmute now if you're talking about the charts. All right. So we had price push through, come back, find support, bounce, come back. People were looking for the long here, right? A lot of people were looking for longs, right? Do we all probably agree on that? Because you got a lot of bulls in here. And this looks like really good support zone on the weekly. Looks like a really good one. Now, why does it look good? Look, I'm going to show you. It's not just, I don't know what happened there. Okay. It's not just price there. What are you seeing? What do you see?
Resistance.
Resistance.
Support on the previous
Resistance.
resistance.
Support on the previous resistance. See how price came up, rejected, came back down, shifted back through. Support. This is on the weekly time frame. I've been weighing the weekly higher than any other time frame. And if you look at most of my charts, they are on the weekly. So what was the intention here with price coming all the way down here? What was their intention?
Rip it back up.
It was to rip it back up, but what was their intention outside of ripping it back up?
To
Looks
take
like
out
it's-
those, to take out those longs.
To take out the longs. The smart money that thought they could long from here. They wiped them out.
Expanding wedge.
Yeah, they literally wiped them out. Think about that.
So if you were smart and you saw that trend on the bottom, you should have took the long from that trend.
Mhm.
And then if it didn't hit, it didn't hit. But
Now, where did I get my price from? Let me show you on the weekly. So we valued this as the high because that's where they found support, right? So what would I be looking at for the low? Well, I'd be looking where money came before it came to here. And what do we see? And what do we see?
Support.
Support. Where did money come back to?
Previous support.
Previous support before the previous support. Well, was resistance, now support. So this was what I was looking for on the move. And I could tell you, everybody's like, oh, it needs the whole 20K because everybody's looking here. They're looking here. Everybody was saying 20K. And when it came back to 19, everybody's like, oh, it's going all the way back down. And do you guys remember what I said in Discord? Does anybody remember what I posted?
To be careful.
To be careful and look for what?
A bounce.
A reversal move. The same thing I said on the, and this was, again, goes back to, let me find it real quick. Hold on 1 second. Give me 1 second, guys. This was my inverse head and shoulders. So this was a chart I threw up for you guys, and this was my inverse head and shoulders. So you can see price came up. Now you gotta love these double tops. You have to love these double tops. And you can see here how I identify kind of the zone, right? I'm a little bit low on this one, but I came back and corrected the price on this one because I was looking at this when I should have been looking at this. And I came back and corrected this to 19.6. But you gotta love the double tops. When they're perfect like this, after a bullish div, a perfect double top in the same zone, you're looking for price to come back and find support in the lower zone and break out of the zone. Because this is a head and shoulders is kind of like a manipulated move, right? It is a easily seen price manipulated moves. When you get perfect touches on price, I mean, these are basically perfect touches when you're talking money, right? You got heavy resistance. You got a lower position from the previous zone. You pop back up, you get heavy resistance. You're now going to have less or you're going to have less selling pressure at the low. That's just how these moves work. You get less selling pressure here, price then goes up. Now everybody's talking, it can go to 35, it can go to 48, it can go to 50, it can go to, look, it can go to 100, it can go to 150, it can go to 200, but when? Right? But when? Is that before it goes to 10K? Is that before it goes to 16K? Is that before it goes to 20K? Think about what I'm saying. Think about what I'm telling you. You have to think about these moves from a logical standpoint. Stop thinking the ridiculous move, right? What's the ridiculous move? Well, we just discussed it. The ridiculous move is Chartis / fake TAP. And I called it fake because it's BS that they would sit there and fish people like that. This, people doing this. It's just ignorant and dumb. It really is. And I know that may offend some people or whatever. Maybe you're like, you like these kind of things, but it's just dumb. That's not reality. It's not how money moves.
That's a Twitter trend.
Yeah, it's a Twitter trend. And I see it all the time. All the time. Money doesn't move like this. It just doesn't. There's lots of pullbacks along the way, lots of entries and everything else. Even if price were to attempt to do that, you have to build. That's how price moves. It's a building momentum. Now, some of you may be like, well, look what Bitcoin does over here. Look what Bitcoin did over here. Yeah, you're right on those moves. They did go vertical. When did they go vertical? When?
Having.
After the halving, right? So if we're going to stick to narratives, are we at the halving? Are we anywhere near the halving?
400 days away.
400 days away. Look at that. I actually have a chart that tracks it. So that's our halving date. And this does nothing to do with the economy. This is just, let's say you just want to follow cycles, right? Because I know some people are fully in belief of that. We can go with that narrative. We can go with that narrative. How far away from the halving are we? Pretty far away, right? Well, people are like, well, in the time that we're going to this halving, we can go all the way up here. Okay. Let's support that theory. Let's say we do come up here. Are you selling? Is anybody selling?
Yeah.
Probably nobody. I mean, you could say yeah, but I'm telling you, the second we get back up here, you're gonna see everybody say, "Hey." And those charts that went from this. Hold on, let me find that again real quick. Those charts that went from this are now going to something like this. Whoops. Hold on one second. Do you see the ridiculousness? I'm not even gonna lie, guys. Like, as much as I like helping people and fishing people out of the matrix of Twitter, and I say that because like it is a literal cesspool on that site of just ridiculous tweets. I like Elon, right? I think there's so much bullshit that floats around Twitter that it confuses people.
Most of the lists that the influencers put down, they're mainly their small caps that they've already loaded up. So they're just hoping to create the narrative so they can exit.
Yeah, they create communities around a specific coin that they've got big bags in. That's why when you see, I don't know, we'll go with Q&T mommy, right? Why is she Q&T mommy? Well, Q&T is the future. Q&T this, Q&T that. How big are her bags? How big are they? Ask yourself when you're following influencers into a move. How big are their bags? Go look on chain and look at their position sizes. And I don't mean
They
theirs
were-
specifically. I mean wallets. What's up?
They were small, but they just grew from their community.
Yeah. Yeah, you have to understand that these are all narratives. Can you ride the wave? Sure. I'm all about that. You guys saw that in 2021. I was riding waves left and right, but I knew to get off them. Other people rode them all the way down to 98% losses. I took them at the highs.
So what is the main reason it doesn't moon after that? Are we still looking at the RSI?
What doesn't move?
Or is it the pattern? Because
Are you talking about Bitcoin?
this chart we're on right now, is it not Bitcoin?
Marty, how much hex you got? Hex to me, hold on, we'll cover that in a second. You're good, you're good. Hex to me is just it's a way to farm engagement because Hex is literally like the safe moon people. And I don't mean like Hex is like safe moon. I mean the community, right?
No, I'm just fucking around.
Yeah, no, I get it. It's just I don't know why their community is so big. And then like if you go on chain and look at their average purchases, like PulseX, for instance, right? The average purchase I think was like $10 for PulseX. I don't know if anybody knew that, but like when you look at things like that, it's like their community might be big, but they're poor, right? And I don't mean that in any way to insult, but this is how a lot of things pump. You get a lot of people that have hope to get out of their situation, hope to make money, and they pump these things as much as they can through just through the internet, right? Through Twitter, through whatever. Like they're not paying for articles and stuff like that. The biggest bags are, but these
Those
people
poor handbags.
yeah, these people get conditioned into thinking they can turn $10 into $1 million, so they put their $10 in. And that's probably the only $10 they have to invest. And it's sad. I'll tell you that. Now again, it doesn't mean that Hex specifically. Like I'll tell you this. I hope, and hope is not an investment strategy. Richard Hart pulls it off. I do. Because it will be the first person, because so far he hasn't done anything to me to make me think that he's going to wreck these people. Because he still has his big bags he had in Hex originally, right? He's probably sold off quite a bit, made some money. But the fact that he hasn't sold them to the floor yet, that's pretty good in my eyes. We'll see how that turns out in the years to come. If he can actually make a sustainable chain though that makes sense, hey, I'm all for it at the end of the day. So I'm not gonna necessarily talk down on him until I see something bad happen, right? Then I'll respond the way they respond. His face is out there, just like my face is out there. Most of the influencers you guys follow on Twitter and stuff, they don't even have faces. They just talk big game, but they won't even show their face. I show you guys my face all the time. I have no problem showing you that. I mean, some of you even know how to, navigate your way through my Facebook, everything. Like, I don't care. Like, you can have me on Facebook, is whatever. Like, I want you guys to understand, like, I'm trying to be as genuine as I can as a person to you guys and show you guys the right way to trade and the right way to do things. For me, it's not an engagement form like it is for everybody else. And I got people that straight up dislike me because of that. Like I've had big influencers block me and stuff, and it's like I don't care. It's whatever. I'm not here to be their friend. I'm here to help retail. That's what I'm here to do. And I've said this many times in many spaces and everything else. Like that's my intentions with all this. Yeah. So, man, there's so much to cover in the amount of time we have. I do want to get, because Aaron's here too, so I did want to kind of talk about the bank situation and kind of your thoughts on that, Aaron, if you wanted to kind of chime in on that, and I can give you kind of my thoughts if you have time.
The bank situation.
Yeah, and it's not. This is the thing that everybody thinks. They think it's about the banks specifically. And I if you could give a take on what else this involves other than banks, because people think like they're like, oh well, this is like the FTX thing. FTX blew over and everything continued up, and I don't think they understand the depth of what's happening in the financial system.
Liquidity crisis.
Well, I mean, FTX was just one, major exchange, right? And that was in the crypto market. And I think that FTX's market cap was somewhere around 50 billion-ish or 30 billion. You have, Silvergate was at some point maybe a 10 or 20 billion dollar company. I can't really remember. I think SVB was much larger than both.
200 billion for SVB
Yeah.
at the peak.
Was it 200 billion market cap or 200 billion in assets?
200 billion in
Assets.
total with assets and everything.
Right.
Yeah.
So, you're having, that's a much, larger institution, and that's the second largest bank to go under since the great financial crisis. So, it is historical. But I think what's most important from this is that, over the last year, you've had smaller bankruptcies, mainly focused in the crypto space. So, you've had Voyager go under, you've had Celsius go under, then you had FTX, BlockFi. And so with that, you're already starting to see the loss of confidence, where you started getting runs on the banks for those smaller crypto exchanges or crypto related banks, or where people held their money in the crypto space. Those were, classic bank runs where too many people pulled their money out at once, and the exchange didn't have enough, liquidity to meet those redemptions. And so that they were insolvent. Well, same thing happened with Silvergate. So Silvergate, back in the fall of 2022, they, had a lot of exposure to the crypto market. So they were taking a big hit, as, some of their hedge funds, other exchanges within the industry, had to either pull out or took their own losses. That was less money that they were banking with Silvergate. But people started, pulling their money out of Silvergate, and Silvergate was basically running a structure where they were, using people's deposits to invest in securities to earn interest. So, they might have taken 50 billion in deposits, and 2 years ago bought, a bunch of, 10-year, 30-year treasury bills yielding like 1% or 2%. And, take 2 years later when, this bank run on them goes down, so a bunch of people pull their money out. Silvergate doesn't have the liquidity to meet those capital requirements or redemptions, and they don't have any money on their balance sheet, but what they do have are a bunch of US treasuries. Well, they bought those US treasuries that are yielding, maybe 1 or 1.5%, but now the market yield is about 4%. Who wants to buy a bond that's yielding 1.5% when you can go out and buy a new issued bond for, 3% or 4%, you're getting more than double the yield. And so what happens is the bonds that were on Silvergate's balance sheet, when they went to sell them in the market, they have to sell them at a discount. And the problem with that is that, it starts off as more of a duration issue, because if in theory they were to hold those bonds all the way for 10 or 30 years, nothing would go wrong at all. The valuation would fluctuate over time, and then at the end they get paid out and made whole. But because they have to sell them early, they have to sell them at a discount in order to meet the capital requirements of people redeeming their money. And so that's exactly what happened. And when they sold them, they had to take massive losses on that book of securities in order to get people their money. And so a similar situation then happened with SVIB, but that was a much larger institution. So then it started to become much more transparent. And now we from where we started, I don't even know what Voyager's market cap was. It might have been 1 or 4 billion, but and same with Celsius. But then you see FTX go down, so you're starting to see the little ripple kind of reverberate through to larger and larger entities that are starting to face issues, to where you had a bank with $200 billion in assets go down. And that just shows the loss of confidence that consumers and business owners and investors had over the last year. I never even thought in my lifetime I'd see a bank run, but we've seen 7 in the last year. So that's pretty crazy. So
can you get into Deutsche Bank too?
Yeah, we'll talk about that. So before I move on, was that mainly what you were wanting me to talk about, Will? Just that dynamic?
Well, I think the dynamic is not as unique as people think it is. And
yeah, no, that it's a problem. Every bank is in this problem. So, and I guess what I didn't talk about yet was that all these banks have the same issue, because they were getting a lot of deposits, and then they were when you, as a bank, when you grow your deposits, you're expected to grow your loan book as well. So banks are, as soon as they get let's just say they get $1 billion in deposits, they're going out and they're trying to do $1 billion in loans that next year to try to earn interest on that money that they're getting, because no bank is expecting there to be a drop in deposits. It's very rare where you see a liquidity crunch like that. But what's really happening, and it's hurting a lot of the smaller financial institutions, is because of the FDIC insurance, only up to 250K is insured, which incentivizes larger players to say, oh, well, why would I have my money in a bank that could fail? Like, why wouldn't I just put my money with JP Morgan, Citibank, or Bank of America, an institution that's going to be too big to fail? If the bank goes under, I'm totally insured on all my money, because the government's going to basically back it up. And if the government's not backing up these regional banks, why would I keep my money there? And so the regional banks are seeing a much tougher time with liquidity, and this is kind of the case with First Republic, you know, even I looked at my bank account the other day, and it's silly that I've just been like I haven't really just focused on moving around with my like savings money or anything, but I bank with Truist, and I looked, and you know, my savings account's earning like 0.5%, and I'm like, this is criminal, first of all. But all of these like banks haven't raised their savings rate, and
That's what I wanted to get to. Go ahead and go into that.
Yeah. So I mean, because you know, you have T-bills yielding T-bills were yielding like 5%, you know, all these regional banks, and even, you know, JP Morgan, I mean, all the banks, none of them, they were over the last year, and I didn't even realize this myself, and it was kind of like a late cycle type thing. So you had a small, like a minor improvement in a lot of these banks, not all of them, but some of them, like JP actually saw some improvement in their earnings over the last like 3 quarters. And some of them just kept getting worse and worse. Like Goldman Sachs kept getting worse and worse. But there was a couple that showed improvement, and a couple that didn't go down or get hurt as much as I anticipated that it would. And I think part of that is because a lot of these banks were just raking in money on their NIR, which is your net interest revenue. And, you know, because they're earning this massive spread, because they're basically taking your deposits, they could be deploying that at whatever rate and earning X amount rate and giving you 0.5%. So if they could, for all you know, could be taking your deposits, buying T-bills with that, earning 5%, gaining, you know, more interest revenue, and only paying you out nothing because they didn't raise your savings rate.
Real quick, not to throw you off, but let's talk a little more about like car loans, home loan interest rates, and so on and so forth. From banks, like what the average was and what it is, and so on and so forth. And
yeah, I mean, well, let me go into that in a sec, because like, let me wrap up what I was basically
go ahead.
saying. So the point I'm trying to make right there was that you're getting a lot of strain, and you're seeing your these banks deposit liabilities fall dramatically because people are realizing that they can pull their money out of their bank and put it somewhere else and earn a better yield, whether that's buying T-bills themselves or putting their money in a money market fund. And so that's what's put a lot of strain on these smaller regional banks, where you're seeing the liquidity dry up very fast. And so that's kind of what's, like, in a nutshell, what's going on in the banking sector right now. But to what you were just saying, I'm not necessarily sure what exactly you wanted me to hit on with, you know, interest rates and car loans, but
so I can lead it real quick, and then you can follow.
Yeah, go for it.
So I guess my thoughts is like your average car loan, 5%, 3% is what the bank's making. Your average home loan, probably 3 to 1% or 2% is what your bank's making. And the people that are giving the loan money is typically, you know, the depositor and or private entity that's funding the bank to give those loans. And the private entity would obviously make a higher percentage than the depositor. The depositor is basically making nothing off of these positions. Not only are they making nothing, the bank considers it, if you don't have direct deposit with them, you're paying a fee every month to keep your bank account open, which is bullshit at the end of the day. So they're making revenue hand over fist. They've been doing it. The 10-year and 30-year is just a secure way of holding the majority of their funds. But I think they were over leveraged on the side of giving loans out, right? And then, not in addition to giving loans out, even at higher interest rates, I've seen people as high as 7, 8, 9, 10, 15, 20% on a car loan. Like these are massive loans.
Well, no, I think that I can't even. I mean, I thought I saw some recently where, you know, your average car loans anywhere from like 9 to 12%, which is pretty crazy.
Yeah. So to touch on that, what I want you to understand is that the depositor is making nothing on that. The depositor is now understanding this. They're like, why the hell am I letting them just hold my money? I can make money on my money safely, right? In the market. And it doesn't mean buying stocks. It doesn't mean buying crypto. There are lots of safe ways to put your money through ETF bond followings, right? So an ETF that follows bond price but doesn't necessarily lock away your money. There's plenty of those that you can put your money in and pull it out whenever you want. There's a ton of different ways, and now I think these bear markets make a lot of financial institutions smart money. They make a lot of even dumb money intelligent to the fact that they are getting robbed by the banks. This then in turn creates this instinctual position where it's not we need to get our money out because the banks are failing. It's I have better opportunity elsewhere, right? And I think
Right.
that's the bigger part that people are missing. They think that this is a bank run because of liquidity. I think it's a bank run because of opportunity, and people are seeing that opportunity and they are removing their money from the system, and this is creating the liquidity crisis. It's not a panic
totally.
on banks because
Well,
of liquidity.
Well, it's partial. I mean, I would say it's a negative feedback loop, right?
Mhm,
So I
yep.
mean, whereas I would say that it initially started as, I'd say it initially started as I'm taking my money out of here because I can get a higher return elsewhere. But then, once that triggers some of what we've seen now, there's mistrust, and then there's additional runs on the bank because people are fearful of liquidity issues. And then that in turn turns into more financial stress and more people pulling their money out to seek opportunity elsewhere that's
Well-
safer and a yield. And then it turns into more liquidity. It's just like it's a negative feedback loop.
100%. And I do agree on that. I'm not saying there isn't a action to what's being done. What I'm saying is like CNN, CNBC saying that this is a fearful withdrawal is just they're lying.
Oh,
They're
well,
not dumb. They know
yeah.
exactly what's going on. They know that people are withdrawing from the system because there's no good yields in the banks.
Right.
But they're not being honest to the public. They're telling them that this is a bank run due to fear.
Yeah, they're never honest. And I guess that's, I don't know really. I don't know what their gain is. Like, I don't know what
I
what
think it's
drives
political,
them.
but yeah.
Yeah. I mean, I don't know where their money comes from, but yeah, they're generally dishonest. I mean, and if for those of you, I usually like look at their headlines every now and then just as for behavioral. I use them as like a behavioral indicator just to kind of see like what they're putting out to the world to kind of understand what, the talking points of the day might be or what people might be like chasing or what it might be. So I can like either determine how relevant it is or whether there's actually like a really strong side to the other side of whatever they're talking about. But yeah, I mean, it's kind of crazy some of the things that they put on that network, right? It's in my mind, it's downright misinformative and almost
all of
criminal.
them. It's not even. It's not. This isn't a political thing. It's every single news station, Fox,
Yeah.
CNBC, CNN, all of them. Even I forget PBS. PBS used to be like an educational thing. Now it's a politically driven tool. The biggest thing that I want you guys to understand: look deeper. When you see headline news, and this is why, look deeper. Imagine if they came out and said, "Hey, the bank runs are happening because people see better yield in other things other than the banks." Imagine how that would impact people. That would open tons of people's eyes to what's actually going on with their system and how much of a Ponzi scheme it is in reality. But they can't do that. They have to toe the line. This is a political Ponzi scheme, in my opinion, that they're just trying to keep alive at the end of the day. I don't want to go too deep. I want to let you finish your thoughts though, Aaron. So if you want to kind of go ahead, I just want to kind of add that into what you were saying, just so everybody can understand.
Yeah. Well, I mean, that was pretty much, in terms of what prompted the conversation, that's pretty much all I had to say about that. If anyone has any questions or if you had any questions about what I had to say, that's in a nutshell, the dynamic that's, kind of caused a lot of this financial stress.
Let's touch on credit real quick, Aaron, before
Yeah.
you end.
Yeah. This is so if you want to pull up a chart at HYG, This is you're starting to see this big divergence finally, which it's blown my mind that it's taken this long. But so you're starting to see high yield credit deteriorate against, you know, US Treasuries. And for a while you were kind of seeing a lot of so high yield credit was a great short all of last year. I mean, you know, risk was rising. That's generally really bad for high yield credit. But at the same time, we had a big interest rate shock last year, which is also bad for high yield credit, but it's also bad for treasuries.
Can you go into the sectors of high yield credit real quick so people understand?
I mean, it's just so, you know, this is going to be a lot of your profitless tech companies, a lot of energy companies. This is basically corporate debt. So this is corporate debt that would exist for, you know, profitless tech company, energy companies fall into this bucket a lot of the time, and other, you know, maybe startup companies. And even like you can think about like even some of your smaller crypto firms, if they were to have debt that traded in the market, that would be considered high yield most likely because it's riskier debt. So it's riskier debt, and these rates are generally like so there's a spread between, you know, what one of these companies might have versus the US Treasury, and that's called a high yield spread. So like if the 10-year yield is, say, you know, a yield of 3.50 or 3.5%. And so Carvana might have a yield of like their bonds might trade at like 10%. So that would be a huge spread, you know, like in terms of the risk, because the larger the difference between what a corporate bond trades versus what the US Treasury trades at, that signifies more risk. So in that case, that would be 6.5, you know, 650 basis points spread between those two, which is a very large spread and signifies a lot of risk. And yeah, so I mean, what you're seeing is, you know, big downtrend, but Will, if you zoom in, if you can go into the daily, because this has been a more recent development where you're starting to see the weakness in high yield credit. So this got squeezed up really good in the beginning of January, along with, you know, all your profitless tech companies with high short interest. It was in the credit market. It was high yield credit. Like it was almost like a meme market. Like some of these bonds were just getting huge squeezes in the credit markets, which is very uncommon. And it was really interesting that was happening. You know, I was kind of confused for a while that was going on, but, you know, I just kind of had to roll with it because that's, again, what was happening. But now you're starting to see the divergence where this is kind of trading back towards its lows. You have the Russell 2000. Can you look at RUT real quick? So you have high yield credit back towards its lows. You have your small cap index back towards its lows. And that signifies, you know, your more economically sensitive and higher risk companies and higher risk debt are actually, you know, starting to break down. Meanwhile, you have your QQQ, which is back towards the high end of its range. So people are basically piling in to one sector right now, and that's just your mega cap tech. Everyone's buying mega cap tech, and, you know, you're seeing high yield credit and small cap stocks deteriorate underneath the surface of the market. So that's something that's been interesting to me recently. But yeah, Will, so can you do like a comparison chart between HYG and TLT? So this is what I mean when I'm talking about you're starting to see a pretty meaningful divergence. So when people buy high yield or HYG, it would be a more risk on mode where, you know, they're betting on, you know, the market going up, people taking more risk. But in a market where liquidity's contracting, people are trying to take safer bets. High yield credit's not going to do as well. People are going to be buying in the credit space, US treasuries instead. So you look at that orange chart of TLT right there, you're starting to see that trend up versus HYG trending down. And that's been an interesting divergence that I've seen recently. And I think that's going to be a good short pair going forward, where you can be, long TLT or long IEF, or 10-year treasuries, versus being short high yield credit or HYG.
Yeah, that's weird. They are kind of starting to move in opposite directions now.
Right. So you see how for a long time they kind of moved in tandem for a long time, right? And that was more because I think last year, even though you were starting to see some of the credit risk and certain risks surface in the market, a lot of the movement in the rates and bonds in credit space last year was solely like out of rate sensitivity, because the interest rate shock wasn't good for TLT either, and anyone who owned US treasuries. And that's pretty much evidenced by both of them, trending down and moving up together. But in the recent days, and this is mainly since SVB failed, so this is literally brand new, within like 2 to 3 weeks, you're starting to see this divergence.
Now, can you explain what the bond market indicates versus high risk yield, so people kind of understand it from a deeper level?
Yeah. So what I would say is that this indicates that, the market is generally looking for a safer return. They're basically opting out of, the high. Well, first of all, a lot of this high yield debt is completely illiquid, and anyone who needs liquidity, they don't want to have a bunch of high yield bonds on their balance sheet that they can't get rid of if they need to sell them. And so if, like, from a balance sheet perspective, it's better to be able to hold more liquid assets. And so, from a liquidity standpoint, owning US treasuries is one of the most liquid assets there is. But it's kind of like a safety trade as well. So you're seeing people buy, US treasuries out of, slowing growth and recession fears. And that's during recession, that's where, when you see companies go bankrupt, there's a reason why the high yield market exists, because the bonds are riskier. And if a company goes to zero, that means those bonds are in danger of being worthless, or the company for the underlying bonds is worthless. And now there's, that's a big credit risk. And that makes, you're basically buying quality over,
Over trash.
Yeah,
Over
that's
trash.
what the trade is.
Yeah.
And there's
Go ahead.
one more component, I'd say.
Go ahead.
The last component is that, the long end of the curve is starting to see, I think it's starting to recognize, and this is partially what's been going on with gold as well. It's starting to recognize that, we're getting towards the end of the terminal Fed funds rate, where they're not going to be raising it much higher from here. So, it's right now the market's indicating that the Fed's indicating they're probably going to do one more in May, and that might be it. If that's the case, it's starting to get safer to own the longer end of the curve. And because remember, the longer end of the curve is controlled by growth and inflation, rather than the short end of the curve is just controlled by the Fed's policy. So if economic growth is slowing, which it is, inflation is slowing, which it is, that means that you're going to start to see the long end of the curve trend lower more meaningfully. And that's positive for your, 10-year note and your 30-year note. And if you look at that chart of gold, there's a big, it's interesting to see how it did kind of coincide with how HYG and TLT moved up until the last month, maybe, where you saw a very noticeable divergence between HYG and and gold. And that's, again, reiterating that it's a lot of that has to do with the interest rate sensitivity and the bond market, kind of the long end of the curve signaling that, the growth is slowing faster, and it's likely that, the Fed funds rate might not be going up much higher.
Can you explain the curve to the people so they understand what the curve is?
Right. So the curve is just whenever I or someone refers to the curve, they're just talking about a broad spectrum of US bonds, US Treasury notes, right? And so that's going to be, your shortest dated, they're called bills, are going to be your, 3-month T-bill, your 6-month T-bill, and maybe a 1-year, 12-month T-bill. And so those are going to be your most liquid types of, rates, where it's essentially the equivalent of, it's basically the essentially of a US dollar equivalent, except you're going to get a yield with it. Then, you go out to 2 years. And so that's your shortest dated US Treasury note. After that, it generally goes out to 5. And then there's a 7-year bond. There's a 10-year bond. And then you have a 12.5, a 15, an 18, a 25, and a 30. So when I say the curve, you're basically going from the shortest end of the curve, which would be 3-month T-bills to 2-year Treasury bonds, all the way out to, say, a 10-year US Treasury to a 30-year US Treasury. And that's what I would refer to as the longer end of the curve. And so that's, if you're looking at the yield curve, that's, you're looking at the spread between the 10-year yield and the 2-year yield. That's what the curve is, essentially. And again, the longer out on the curve you get, the more those bonds are associated with growth and inflation, opposed to Fed policy rate.
And I know a lot of you that may be a lot to take in, and it may sound like mumbo jumbo because you're not as familiar with finances and stuff like that, and kind of like how all this game is played. But always pay attention to bonds, right? Like, and I think this is a great indication you brought up here, and maybe not a lot of people understand it. But I mean, to me, the way I take this chart specifically, this is high yield trash, and we call it trash not because it's necessarily trash. It's just a lot of this is illiquid, or they're giving money out in the hopes that they can get a high return on that money. And usually with high yield is high risk. So when you're talking high risk, that means there's a lot of issues with the model that they were looking at to give the yield out, and that's why the interest rate is so high. And when you look at gold, go ahead. You want to jump in on that?
No, I was just gonna say, like, for example, I haven't looked at Carvana's recent financial statements, but whenever I was putting together an example for one of my previous macro discussions, where we looked at Carvana's, one of their bonds that they had, I think they issued like 2 or 3 billion of debt at a 17% rate or something crazy like that, right? The reason why the rate is that high, because there's that much risk associated with owning that bond. That's a crazy high rate. That means it's like there's so much risk.
Mm-hmm. And those are the ones with those type of yields that you would look to fail in this type of environment.
Exactly.
And I think a lot of people, you got to look at it from that perspective, is like, how many failures do we have potentially in the system? So when you look at overall failures, we have a lot of failures that can happen based on the high yield. And that's why you have to be highly cautious where we're sitting at, because we're seeing the flee to safety and we're seeing the fleeing of high yield. So that means that, like, even though you think Facebook is safe and you think Google is safe and you think all these other things are safe, they are going to fall under this scenario, even though they're not high yield really, right? But they're high risk as far as P&E. when you look at price to earnings and stuff like that, you look at their overall books, like they're just setting well above normal pricing. So that pricing deflation will happen in all the assets as retail begins to slow their buying pressure. When you start to see that buying pressure slow, and you see that, okay, we can't charge these ridiculous amounts of money for an iPhone anymore. We have to drop it by like 30% or 10%. When you start shaving down those profitabilities, while these high yield growth stocks or bonds are falling, you're going to see those that start to get priced into these higher priced products. And those higher priced products will start to deflate with the deflationary environment, which means earnings will go down, which means the overall cost of those stocks will drop based on, evaluation of what they're earning to what they're actually yielding and so on and
Right.
so forth.
Right. And alongside that, your companies that are profitless right now, let's just like take Wayfair, for example, right? I mean, this is a company like I don't want to everything I'm about to say here is like not anything to it's not a financial analysis. It's going to be completely just arbitrary. But this is a company that's had balance sheet issues, so I'm just going to use it as an example for the next part of this conversation. So as Will was just saying, people have to stop spending or whatever it might be. Let's just say Wayfair's revenue goes down even more. That means they have less money in their that's coming in to pay off their liabilities or their debt. And what that would do is inherently make their bonds, the rates on their bonds go higher. And so that's where you'd start seeing their bonds basically trade lower. And that's what HYG is, right? That's what HYG is comprised of, is companies that have bonds that have higher yields. And so these companies, if they're not able to, if their businesses, like their business trends go down because the economy's bad, or they're not able to sell as many items, and people aren't buying as many, as much this Wayfair is, home furniture. People, aren't refinancing their houses as much. They're not purchasing homes. They're not furnishing their homes. They're not, they're just trying to cut back on whatever it might be. And Wayfair is not getting enough money to cover their debt. Well, that puts them in a situation where they're at risk of bankruptcy. And so now owning that debt becomes much riskier, and the price of their bonds fall because, let's say their bonds yielding 10, but because, their business trends are getting worse and worse because people are spending less and less money, maybe that bond yield goes from 10 to 15%. So the price of the bond would plummet in that case. And, that's just an example of how, a company that's already in a bad situation right now could get much worse as consumer spending dries up further and companies make less money.
Yeah, and consumer spending in the type of environment we're in is what will be affected the most. Like, we have to understand that retail drives price, and retail is what drives, we'll say, speculation on stocks and so on and so forth. So if the company is not performing from a price to earnings standpoint, you're basically looking at a company that's going to come down, if not fail. And a lot of these high risk yields basically are companies that they're not performing at all. They're basically
Right.
not turning a profit at all right now.
Right.
And these are the highest risks to go out of business. And basically we're seeing the bond market react to that, because they're basically, what I would take this as for the bond market is, the bond market is signaling, we see real systemic risks in the current economy, so we're fleeing to safety, right? And I know some of you may think that Bitcoin is that thing. No, Bitcoin and crypto in general, to the stock market, to big investors, is still a high risk asset. We have to understand that. Do not fall for the BS at the end of the day. It is a high risk asset. Why? Because of liquidity.
It's really, and I think what more of it's been the strength of the NASDAQ recently that's probably propping up Bitcoin, because you're seeing, your mega cap tech remain strong, and, you're seeing weakness in the Russell, you're seeing weakness in the S&P, but the tech, specifically mega cap tech, you're seeing much more resilience. And I think that's what's been kind of holding up Bitcoin, at least. It's kind of been trading hand in hand with that. And one thing that was interesting that I saw that Keith McCullough had pointed, he had pointed this out. I noticed this from like I visualized this myself, but he like quantified it. So there was 450 billion market cap that got erased from the banks in like 2 weeks during that SVB sell-off, right? Well, your mega cap tech plus Nvidia and Netflix had basically gained 450 billion in market cap during that same period of time. So what you saw was just a huge flow. It had nothing to do with, it was just a big flow trade. It was about people and big money and asset allocators basically selling their financials and reallocating those funds to the tech sector, like almost identical amount of market cap gains for that, for Microsoft, Google, Amazon, Apple, Meta, Nvidia, Netflix, basically, that was lost in from the financial market cap, which I found to be really interesting. And my Friday reading this last week, I basically wrote about how, if you're an asset manager and you're handling clients' money, you're going to feel much more confident going into a meeting or a quarter end report saying, oh, don't worry about anything. Everything's fine. We don't have any exposure to financials. We own Apple, which is up X amount % year to date. And so, seriously, like people, it's all like they could have lost a bunch of money on a trade or a position and just reallocated it. And they're just showing the clients like, hey, this is how we're positioned. We don't have any financial exposure. We're in Google, we're in these Microsoft, these quality, tech and Apple, these quality tech companies that are up year to date. And so that's kind of the dynamic I think we're seeing into quarter end. And it's just been a massive flow trade.
Yeah, I think Apple ultimately is going to end badly for a lot of people. I think a lot of people got fished into Apple thinking that it's a safety net, and it's not looking too great. I'll tell you that. I'm looking at a falling wedge, right? Or not? A bull flag. But ultimately, this could turn out a lot worse than that, and this thing could be like a permanent downtrend for a while.
Yeah, I don't want to rip on someone, but there's someone I remember, maybe it was like a couple months ago, calling for like the tank of Apple to end the market, and that was basically at the lows.
Oh, at the low down here,
like literally at the lows. I had said that the numbers might not be good, but one thing I will say is that whatever it is, it's basically trading down lower into its earnings report, and I wouldn't be surprised if
right back up.
Yeah, I mean, that's what happens when you get to the low end of the range. You never know when it's going to rip back up on you, but when something's trading towards the lows, just back off the gas on the short. You had a good short, now you cover it. Don't press it when you're at the lows again.
Yeah, and I think the lows have been pretty obvious here. Like they've been floating this thing for a while. If you look here, I mean, it's basically previous lows.
Yeah,
and you got this bull flag, which looks great. I mean, the bull flag looks amazing. If it can continue to hold this trend, that'd be awesome. But I think ultimately where we're sitting at right now, you're at higher risk looking for a breakout than you are looking for a short from here.
Yeah,
and good.
That's one I'm just not going to touch. I mean, I have like my shares, and I haven't put a hedge on for those yet, but I mean, that's one that's been surprising is not gotten crushed yet, but I think it'll go lower at some point.
Yeah, I'm just looking for it to follow.
Market trades lower.
Yeah, I'm looking for it to follow trend. That's all I'm looking for. Like it's not even me about like, oh, we're gonna break all the way down to here. It's like, if we follow trend, it'll be trading significantly lower. 119 is really low, right? And then we'll see another move up or we'll see another move down. We'll see how this plays out. It just depends on how long, we hold these rates where they're at. A lot of
Right.
people are anticipating that, we're going to see cuts in rates in May, and that's something else I want to discuss too. But
Yeah.
I want to kind of touch back to banks on
Yeah,
the
let's
credit
go to the-
situation.
Well, okay, we'll
But you go ahead and
talk
finish what
about-
you're doing.
Well, we're good. That was a good segue back into let's we'll basically we'll talk about credit default swaps, and then we'll go into, rate cuts or hold steady, whatever it might be. So yeah, I
Okay.
mean, basically back, like almost all of last year, you started to see, so what one of the biggest signs of when it's time to like really like get like risk off is when you see high yield spreads break out over 300 line. And so that happened towards the end of December or early January was where you saw your high yield spreads go 300 over. And that's generally a big signal. I don't have a chart of that I can show you. It's if you want to pull it up, it's on fred.com. We don't need to, I don't think we need to dive into that, but
Okay, go ahead.
that's a very big risk off signal is when your high yield spreads break out over 300. And from there, we really started to see a lot of, credit default swaps in, the European markets, because, the European markets took it on the chin early in the last year's bear market because, obviously, there was a war in Russia and Ukraine, which exacerbated the inflation situation globally because you got a big oil shock and natural gas shock. And yeah, so if you zoom in 300, which would be signified by, I guess, so I mean, it's been over that 300 line for a while now. So that forward would just be like 400 basis points. Anyways, so, a lot of the European situation was exacerbated early from the Russia. Sorry, what? Can you hear me?
Let me just mute everybody and then you can talk. All right, go ahead and unmute yourself, Aaron.
So a lot of the issues were exacerbated early in Europe because of, the Russia and Ukraine situation. And that's where you started to see a lot of their banking, a lot of their banks' high yield credit spreads just go way out. And so for, again, 300, similarly to, the high yield OAS, 300 line for CDS matters. And so when something's credit spread or credit default swap gets over the 300 line, that's like the danger zone. That's where okay, something really bad could happen. It might not happen, but that's where bad things really happen when a company's or any a company's credit default swap gets over 300. So Credit Suisse got up and over 300 pretty early in I want to say it's maybe early 2022. By maybe it was fall of 2022, you had, maybe it might have been 500 or something ridiculous. And this is where, you had your European, or you had your UK gilt crisis. You basically were having these pension funds that were getting nailed as, the UK 10-year yields went almost parabolic. And you had you almost had a financial event. And then the Fed came out and had a meeting where he kind of backed off the gas a little bit. And then, he didn't do anything to loosen financial conditions, but his rhetoric loosened financial conditions all the way from October to February of this year, essentially. And so that really lines up with, if you look at the lows of the market were in October, and then the most recent lower high was February 2nd. And then right after February 2nd, or maybe even on February 2nd, was when we had Powell's meeting where he like reiterated higher for longer again. And you saw financial conditions tighten after they'd basically loosened up for maybe like 3 to 5 months. During that period of time, financial conditions were easing, high yield spreads went back down some level, high yield spread. So like when we were talking about HYG getting squeezed, we saw, we just saw financial conditions easing overall in the market. So high yield spreads went down. But one thing that I noticed and called out was that, even though we've seen financial conditions loosen, Credit Suisse's credit default swaps were back up at 500. So even all these financial conditions ease, but you had Credit Suisse's credit default swaps like go up, which was a major divergence from all these other pockets of the market. And for me, that's something I've been following for like the last year and a half. And the condition of that company continued to get worse and worse and worse until, up into last week, it went out of business or had to get basically bailed out by UBS. And, there's other banks out there, and I published some in Will's Discord, or financial institutions that have higher high yield spreads than Deutsche Bank right now. Like, Will, if you pull up a chart of LNC, that's Lincoln Financial. It's a insurance company, I believe, or a life insurance company. Their high yield spreads might be like 357, so they're in the danger zone. But so yeah, what we saw with Deutsche Bank was they went from like over the last month, where I had a picture somewhere, and I posted this in the Discord, was you had Deutsche Bank's credit default swaps were like 60, and that might have been February 14th. And so you fast forward basically a month, and their high yield credit spread went from 60 to like 220. So that's like a 3x basically, or over almost a 4x. And so what that's signaling is you're seeing much more risk now getting priced into the European markets. For a long time, everyone seemed to be firmly in belief that, Europe was going to avoid this recession, which, wasn't going to be the case, with German retail sales being a big indicator for that. German retail sales have been negative for like almost like 5 to 7 straight months. That's not indicative of a growing economy by any means. And so, the consensus got behind, long Europe, because it's going to avoid this recession that we're going to have in the US. In reality, their situation's not going to be, not much different than ours. If anything, I think it could potentially be worse, given they have a lot more leverage with their central banks. But yeah, so that's basically what we've seen with Deutsche Bank recently is, I think on Friday their credit default swaps went out at like 240. So just keep an eye on it, because it's not above that 300 threshold yet. And it's probably at similar levels as it traded during like the European debt crisis and with the financial crisis back in 2008. So it's not like an imminent, like this company's going out of business, but it's just something to keep an eye on. If you see on Twitter, if you're able to follow the credit default swap somehow on your own, and you see that it gets over 300, that's where, I would be more concerned about the institution, because that's where, things can get really bad, or things can break it when their credit default swaps go over 300. So remember that 300 line. But yeah, Will, if you go back to a chart of LNC, this is a life insurance company here in the US, I believe. And I think, I don't have my notebook in front of me, I can pull it out just to confirm, but I'm pretty sure their credit default swaps are like at 357. And so that's yeah, that's your danger zone. If I'm reading that correctly, I got my notes here. I had oh no, sorry, 237. So that's not over the 300 line either. 237.
So they're still good.
Well, I mean, it's not that they're good, because I'm looking in my notebook. That's so here, so the mean for US financials, the mean was 129. Okay, so out of like a bunch of different like, I can't remember how many it was, but Hedgeye had produced a bunch of data, then it pulled like the mean average for maybe like 20 or more like financial institutions. And so the mean CDS was 129. So at 237, you're greater than the mean. On a week over week basis, the average increase in the credit default swaps was 19%. On a month over month basis, the average increase was 37%. So Lincoln Financial, on a weekly basis, their credit default swaps were up 33.9%. So you're greater than the mean there. And then on a monthly basis, they were up 72%. So month over month, week over week, and month over month, it's higher than the mean. And then at 237, it's also higher than the US average mean as well. And yeah, so I mean, it's still, again, below that 300 line, but it's one that's starting to creep up there.
Yeah. So I wanted to kind of touch base a little bit on credit restrictions and how banks will be affected in that way.
Yeah. So this is in itself its own, it's all like the credit cycles. It's a big feedback loop. And when it's positive, it's really positive. So, when there's liquidity, banks are lending out money, liquidity is flowing into the system. Companies are able to invest, stock prices are going up. People are feeling good. People invest more. Banks give out more money. People are growing their wealth. So they put deposits in the bank. So that feeds off of each other. And then that continues to grow loans. When that happens, there's not, there's a lot of liquidity. People aren't defaulting. So your loan officers at the banks, they're not really checking risks super hard. They're not as conservative. They're a little bit, they're in risk off mode too. They're not scrutinizing all these different deals that their originators are bringing to the table. And so from an internal policy perspective, so you have, a bank is essentially like, its own, governing entity. They have risk protocols in place. They have, you have your production side, which is like the side I work on at a bank. Like we go out and we try to produce business, produce loans, grow loan growth. And we're trying to make money. Like we're trying to go out and invest and find real estate projects that we like and invest. Whenever we do a project, we have to take whatever we do internally to our credit committee that's ruled by a credit officer or senior loan officer. And they have to review our work and decide whether or not it's a deal that the bank wants to do. And so this is just on the real estate side, but this goes for, all types of lending at a bank. There's various, senior loan officers or credit officers that have to give approval in order for money to be lent. And when you start getting into these, the prior set of conditions that I was talking about that was positive, they might be more agreeable. They might not be scrutinizing our work as much. They might just give us easy passes. But what starts to happen is that if once, you start getting liquidity drawn out, you start seeing credit conditions tighten, you start seeing, bankruptcies, that starts to become a negative feedback loop that feeds on itself just as quickly as the positive feedback loop went. So now you start getting, companies going out of business and rates are higher. So the cost of capital is increased. And now your credit officers are starting to understand, well, okay, so for example, maybe this real estate property is not worth it. The borrower thinks it's worth 60 million. We need to triple check that because it looks like it might be worth 50 or 45 million. Also, I think your expenses and your underwriting might be wrong. I think that you're using the wrong assumptions for your rent growth. You're assuming 5% rent growth, but I'm looking at this market and it's looking like it's starting to turn negative. And in that case, this is not a good market for us to be investing in. You know, what I just said was all arbitrary, but it's just an example of, you know, or not arbitrary is not the right word. I was just making up random things to try to get the point across. But you know, that actually is happening. Like I've been in meetings recently, and this is like I can kind of speak to this from a personal like work experience. Will, like I've never been in a credit meeting where I've had like for 4 years I've worked at this bank, and I've never been asked by our credit officer about a property's value until like a month ago. Let that sink in. No one's ever asked me about the valuation that we used in our assumptions until a month ago.
Yeah, I mean, it sounds to me
crazy.
like they're paying attention now, right? Like
but that's what it means. Like,
Mhm.
So when you're talking about, like, I think the Fed recently mentioned like the senior loan officer survey, which I actually published in a Friday reading like maybe a couple weeks ago. I think I actually did it on like the eve of the SVB collapse, because I was just like dumbfounded that high yield credit spreads hadn't gone up more, because I mean, there's a big divergence between senior loan officer credit conditions and like their credit expectations versus what the high yield markets were pricing. And it was not the high yield markets were not pricing anything indicative of what the senior loan officer survey was showing. And if you look at, and I can try to find that chart and post it in the Discord eventually, but that's a relationship over time that's been very like true and is very proven. Like when senior loan officer survey, you know, credit conditions tighten and their expectations go up, that raises, you know, the high yield spreads usually raise in lieu of that after the fact, or even before that happens. So that's kind of where we're at now, where now not only has the Fed raised interest rates higher to tighten credit conditions, but inherently, because there's more risk in the market and you're seeing some companies go out of business, now your credit officers at the banks are going to innately tighten their credit conditions by just being more observant and conservative on the amount of money that they approve to be lent out. And so that in itself now is constrictive on the economy, because if banks stop lending to one another, stop lending to customers, that restricts the amount of liquidity that goes into the market. So now, say your company like Carvana that needs a loan in order to not go bankrupt, they might not be able to get a loan. And so now that's where you start to see bankruptcies accelerate, because banks stop lending out money to people. And that's where, you know, the credit conditions start to get even worse.
Let's go to your Carvana real quick before you move forward.
Yeah.
How do car lots, especially used car lots, how do they typically buy cars? Do they buy them with cash, or how do they buy them?
I mean, really just, I don't really know. I mean, it can be a mix, you know, like some business owners might choose to do it with cash. Some might choose to finance it with debt. You never know how a company's leveraging itself unless you look at the actual like business model.
I think for smaller car lots, and I know quite a few smaller car lots, friends with some that own their own car business and everything like that. Majority run on credit. I think even with the bigger car lots, a lot of them run on credit. They do this typically because they don't have the overhead to buy as many cars as they need to make their lot look full, right? And so they need that credit line to be open so they can continue to buy cars above their current revenue, so they can have a full looking lot so they can attract customers. And really the reality is those smaller car lots are going to get choked out. You're going to see Carvana, same thing. I mean, if you go over to Carvana or you go over to any of these places, there's quite a few different used car. I forget what the one's called. It's a really big one. Used car lots. And you look at their lots, they're half empty.
Yeah.
They don't have the revenue and overhead to sustain a full lot and be able to deal with the current downturn turmoil. So
Right.
that then deters customers, even if they were interested in buying a car, even if they were financially able to, they won't buy it from them.
Right. Yeah, it's what the way a lot of these cycles work, you know, whether it's credit or just general business, it's a positive or negative feedback loop until it's not. Like there's usually some type of catalyst that is the inflection point of this is where it stops getting worse, or this is where it stops getting better or getting good, right? Like at a certain point, you know, I mean, when things are good, it feeds off of each other. And when things are bad, it starts to feed off of it until something happens. And yeah, I mean, that's kind of that's the whole, you know, senior loan officer or credit survey that you might be start to hear about more on Twitter or in the financial news. Like that's what the credit officer loan or just like your credit officer expectations or your survey might show is that these people that are in charge at the banks are going to be more conservative with the money they lend out and who they lend to, because they're more observant of counterparty risk. One thing that I saw the other day for the first time, which was crazy, is the guy that trades all of our agency bonds that we originate basically sent out an email to us and said, hey, I just got a call from like our counterparty risk team within the bank, and I can't execute a trade without their approval for any loan over $44 million. And so just think about that for a second. You know, that's one more check that we have to go through as a team to get a loan out the door, right? So, you know, we do all this work. We have to do checks with our internal credit team. And then then our trader now has to go out. If the loan's bigger than 44 million, the trader has to get approval now from a higher up. And so from a speed perspective, now as a team that slows us down too. So now inherently we're just slower overall, because that's one more hoop that we have to jump through, or one more approval that we have to get in order to do a deal. But also, I mean, that just goes to show how much tighter, credit's getting. Like they're really cracking down and thinking about that kind of stuff and the counterparty risk. So, that's something that I've never seen before as I've worked here. Like I didn't ever even see that during the pandemic. But yeah, that's a new thing.
I want to kind of jump onto the pandemic there. I think actually we were still in an expansionary environment in the pandemic. It's pretty crazy. And credit was actually being thrown out even more during the pandemic. But when we go into these QT cycles where the Fed starts drawing back on interest by raising interest rates, it starts to tighten. The economy starts to tighten itself. And that's what a lot of people don't realize. It's not even about people withdrawing money, people doing this and that. It's the economy. There's a good portion, and I don't know the exact number, and I'll try and figure it out. There's a good portion of the economy that is primarily run on credit, right? And it's credit on credit on credit on credit. It's debt on debt on debt on debt. And that debt is sold to 10 people, 20 people, 30 people in turn. And so when you think about it from those type of situations, you're starting to dry up lines of free flowing money. You're closing doors on free flowing money when you start to close doors on credit. And the credit situation will only get tighter as long as rates remain above zero. And that's basically what I've told people. It's like, you could be at 2%, you could be at 3%, you could be at 4%, you could be at 5%. Those are tightening conditions. When conditions are the loosest, are at a 0% rate.
Well, not just that. Like, well, it's more about where we came from. Like, if we were at, say, like,
if we were 4 to 5, for sure, it wouldn't be a huge detriment.
we came from like zero. So people don't really. I think what a lot of people might not realize, that might not be as like fluent in, bond markets or traditional markets, is that when you have a rate that goes from 1% to 5%, that's a 5x in your cost of capital. right? That's not like, it's not like, oh, it just went from 1 to 5. That's not like that much. It's just a rate. No, I mean, that's like your cost of capital just went up 5 times.
So basically 100 billion is now 500 billion.
Yeah.
That's how people have to think about it. It's you
Yeah.
pay back 500 billion for 100 billion.
Exactly. So, I mean, that's kind of what's going on there. And I guess if we want to segue into what we were talking about with, you know, rate cuts versus hikes and hold, you know, it's really now up, I think, and that's partially why I started getting interested in allocating some money to bonds a little bit ago, is because and gold, because I started to notice that we're getting to the point where if like there's the risk to reward starts getting better, that on the long end of the curve, at least, they can't really, if they do raise it much higher, it's basically like if they raise it much higher from here, it's going to like make things worse and worse, which means that, you know, those long dated bonds will do better. And, you know, there might be there might have been a window where if they did keep raising, you know, if they did 50 basis points here and then 50 basis points again, like next meeting or whatever, you might have taken some like losses, or you might have started losing on that position. But I felt that, you know, there was a reasonable risk to reward where we're sitting at. And so, yeah, I mean, from here, the reason why, you know, bonds coming into this year and gold could be a good asymmetric bet is because where if you get like, if you actually do get a rate cut in June, which I can't, Will, when did you say the market's pricing a rate cut?
They're saying as early as I think May, June, somewhere in here. I think June was the first rate cut, and they're expecting like 5 or 6
When's the next meeting
ones.
is the next meeting in May?
Yeah, I think it's in May. So
Okay, so the market's basically pricing 25 bips in May and then a rate cut in June.
yeah, exactly.
Right. So yeah, essentially, if you get a rate cut in June, it's because like things are like hitting the fan. Like,
I mean, the
only
market's trading substantially lower if we get a rate cut. in
yeah.
June.
So that's kind of like what is played into like this like kind of risk reward analysis that I was thinking in my head of like, okay, if like things do hit the fan, you know, markets are going to trade lower, and you know, that's where your long bonds will generally work. And so you don't even have like, you can be making money long bonds and then being short equities at the same time. And that's like where you can make some real alpha, like being able to ride some of the short down, but also be able to participate in bonds rallying on, you know, whatever is hitting the fan. If they start cutting rates, that's where you'll really start to get the juice in the bonds too. And, you know, I'm not positioned for there to be like rate cuts, but I think the long bond position potentially works if, you know, we start getting to the point where the Fed starts pausing on their rate hikes. We continue to see inflation really meaningfully decelerate, and, you know, economic growth slows the way it has been. That's where, you know, it'll likely work. Where it will like really, really work is if what the market is like actually pricing, if that does happen where they end up cutting rates, that's where it'll really work. And even, you know, if they don't cut rates until the back half of the year, you know, the position you're getting like a, you know, 3 to 4% yield.
Yeah, I think I can get on board with the market in the instance that they cut rates in the scenario that something really breaks and we trade substantially lower on pricing, right?
Yeah.
I can get on board with that theory. So I can agree with the bulls in that scenario, but if that happens, I can see SPY coming all the way down to like right here before that happens. Right.
Well, but I mean,
and I'm saying that because a lot of
yeah.
companies would be affected.
But I think what's misrepresented is that, you know, the bulls, like the bullish thesis for a year now has been, oh, they're going to stop hiking rates or they're going to start cutting rates. And that's never been like that's
That's
never
never been a
been
good situation.
it's never been the good situation when that happens. The reason, like the Fed, and I've said this for a long time, and I learned this from Jim Rickards. They tell you what they're gonna do, and you just have to like listen to them. don't try to go out and like read through the lines like Steve Leishman or like the Fed whisperer does like on CNBC. Like just listen to what they're saying they're gonna do, and they've been generally like their policy's been over the last year to year and a half has generally been in line with what they said they were going to do. And, you know, if people are like, oh, they're going to start cutting rates in June. Well, they didn't say that. So what that means is that if they do that, it's because like something's really, really wrong and they need to like, it's like an emergency rate cut. And that's never a good thing.
Yeah,
So-
I think that's what a lot of people they miss that small portion. They want to hear one thing, but they don't understand the situation that has to happen for that to occur, right?
Right.
And the occurrence of that happening means that something really broke in the system, economically and financially. It'll be the financial markets that will take the biggest hit. And if financial markets take a hit, that means that all these stocks that people are bidding up so hard are going to take massive hits to the downside. And I don't mean like trading like midway half of their move, like probably consuming the entire move, if not going deeper of where they're trading at.
Right.
And I think
So-
that's what a lot of people have to keep in mind. Okay?
Right. So yeah, I mean, that's just something to keep an eye out for. So, I mean, you mentioned TLT the other day, I recently bought EDV. That's it's some duration, like, so TLT, like, so there's IEF which would be your 10-year bonds. TLT has a little bit more juice, like the equity itself, the equity ETF itself has a little bit more volatility. And then you get even more juice when you go out to something called zeros, which it's EDV and an ETF called ZROZ. Those are going to be like your ultra long bond yields. But yeah, so I do see there being some opportunity there as, if we do, I think from a couple of ways that it works, because if we are getting to the point where we're going to the Fed's not going to be, raising rates as rapidly anymore, that's a positive for this trade. If we get to the point where economic growth is slowing the way it has been, that's positive for this trade. As inflation slows, that's positive for this trade.
So let me ask you, does TLT, I guess, trend in the direction of a healthy economy or a slowing economy?
Slowing.
So
like
if it's positive,
so
that means the economy is slowing, right?
But it's also rate sensitive. So part last year, and I got sucked into this trade a little bit early last year, and I had to, I was, at some point, like I got a bounce and I cut it for a loss before it got even worse. I would have lost a lot more if I didn't sell it whenever I did, but it's rate sensitive. So if your 30-year yield or if your 10-year yield are in a bullish trend and they're going up because, let's just say, you have inflation reaccelerating to new highs like we did into the halfway point of last year, that was, even though we had growth slowing, that was a bad trade. I mean, the growth slowing component was there, which usually works for the bond trade, for bonds to rally, but inflation is also a key driver for bond yields. And so if inflation does reaccelerate, that would put my current trade in jeopardy. But I think that the likelihood of that happening is much lower, given we're about to, over the next 3 months, we're going to begin to lap the period of time where we had the oil shocks last year, right? If you remember, around March, April, May, June of last year was where we had oil double top at like 120 a barrel. And so, I mean, in terms of, and from a rate of change perspective, that's why we saw such a huge, like, final, like, blow off top, you could say, in inflation, because the discrepancy, or the rate of change year over year, was huge in relation to 2021. But now, you know, we might be going up against, like, say, the year over year change in May of the price of oil might have been, for 2022, might have been like, let's just, and this is, I'm just making up numbers off of my head, like, it could have been like 30, it could have been like plus 30%. We might get to May this year and the price of oil might be down like 10%, right?
Mhm.
For the month. So that's a, you know, a 40 point divergence, essentially, from where you were up plus 30. Now you went from being up plus 30 in May of 2022 to being down minus 10 in May of 2023.
Yeah, and I think like gas stations and other places are still kind of soaking on the original price because oil itself has driven down significantly, and I think gas prices haven't really followed that as far as the oil price.
Yeah.
Good.
But yeah, that's kind of, yeah, no, that's kind of what I'm looking at on the inflation front. So
Yeah. So this is basically an environment where we get decelerating growth, decelerating inflation. And it's really the more dangerous part of the market. A lot of people think inflation is dangerous. No, inflation is expansionary. It's
Yeah.
basically, it creates an environment that gets kind of out of control. You're going to get a lot of volatility. When you get into the deflationary part where you're trying to achieve a goal or a percentage, that's where things can break significantly. They don't break in the inflationary environment. They break in the deflationary environment. This is why coming down is much worse than going up.
right. So yeah, that's just, I mean, that's something to, you know, consider, to add some symmetry to, I guess, if you're running a hedged or a long short book, you can, you know, you can try like being long bonds versus being short. I mean, if you're doing a pair trade, you know, you add 2% long TLT versus 2% short, you know, JNK or HYG, right? You can be long the quality US treasuries and be short high yield.
Yeah, and the closer we get to our target percentage, also, the worse this can get. And I say the worse this can get because basically we're looking to goal at 2%. Inflation could technically just stop going down at like 4 to 5%. And then we've got a situation where we have to make some additional moves, maybe to make that happen, or we have to hold rates for higher. And this is why I think the Fed is intending and saying we're going to be higher for longer, right?
I
And
agree. I mean,
I
that's
think
what he's been saying.
yes. And I think that's with the intention and understanding of him knowing that inflation is not just going to go become deflation and go to his target goal of 2%. I think he knows that stickiness will occur, and that's why he's saying it needs to stay elevated. And I think
Right.
the bulls are right in some aspect that and I'm giving credit to both, that we could see cuts this year, but I think only under detrimental situations, as in something in the financial markets really break and things really crash. That's the only situation I can see him start to cut. Otherwise, rates will remain elevated, which will constrict loaning and credit lines, and that will constrict money in the economy, and that will slow growth. So that
Right.
slowing of growth then becomes, and I think a lot of people look at unemployment like it's all gonna, it's gonna be something that you can just kind of read happening. I don't think that unemployment's gonna be something you can just kind of read happening. I think if unemployment remains low. Hold on 1 second. I think unemployment remains low. And then at a certain point, unemployment spikes, right?
I agree. Yeah.
And I think a lot of people are not understanding how that moves. It does not move in a way that you're going to be able to see it coming. It will hit you like a
So-
truck when you turn around.
So a couple of things that could happen with that. So again, like, that's like where this trade becomes like where it could work as being a better trade than being long equities. But it's like the real home run on this is if, like, the market is right, or the bull thesis, or what they want to call their thesis, is right, and the Fed actually cuts rates. That's where you hit a home run on this trade, on being long like TLT or something. And supporting of that would, be like, you get a huge jump in the unemployment rate. That would be positive for this trade, essentially.
Yeah, and a huge jump in unemployment would scare markets. Like these markets would freak out and just start dumping. And that's what people got to really pay attention to, is that the narratives that are being pushed are actually not positive, they're negative, right? If you are looking for the positive narrative, you're looking for a soft landing, then you're wanting the Fed to keep rates high, for inflation to slowly decelerate, and for nothing to happen, which means we just trade sideways until the occurrence of 2% happens and nothing breaks. I think that's a pipe dream, but that's the bull thesis in my eyes. That's the way you should be voting if you're bullish, is that that rates remain at this high position. It's not a bearish thesis at all. That's actually it's a bullish thesis for rates to remain and nothing to break. It's a bearish thesis to say rates are just going to start getting cut, because the Fed is going to be late to the game by the time they start cutting.
Yeah. So yeah, I mean, that's kind of my thoughts on that. You know, I'm trying to, you know, I'm positioning myself in a way where, you know, it's going to work in the meantime, but it's going to work. Like I'll hit a home run if like things do hit the fan. But in the meantime, you have to keep trading the chop and the ranges until you finally do get that break.
Yeah, and that break's going to be up where it's going to be down, right? And if it's going to be up, it's going to continue to chop like this until inflation hits 2%, which means you're going to be waiting an entire year or two before that happens. The Fed's already stated that. They said they don't see rates being in the 2% range until 2025, which means we continue to chop sideways for 2 more years. That's a bull thesis. That is a bull thesis, regardless of whether people think it is or isn't. The bear thesis is that they start cutting rates. That means we have really fallen off a cliff. Things have really broken financially, and now they're flipping. And then from that position, that's a fast recovery, right? Once something breaks, you're going to chop like this, and then you're going to start moving like this. That's a bull thesis. So I want people to understand the difference. This is why narratives can be dangerous tools to the uninformed, is because the narratives being pushed have no reality behind what they're saying. This is the real reality. The reality is this chop, drop, and up. One of these two realities. It's not moon. It's just not from any standpoint. We've created a very bad environment for investing. We've created a very bad environment for borrowing. We've created a very bad environment for new startups. We've created a very bad environment for companies sitting with loans. There is no positive situation monetarily currently in the economy. They're all negative.
If you're trading this on like a day-to-day basis, we're kind of in the zone where you have to be like cognizant of what like the overall kind of like what's happening each day, because the days where, like, for example, Friday morning was a great day to, cover some shorts and then add some back on at the close, because, you had the media was starting to blow up, say like the Deutsche Bank, CDS fear, right? But right now we're going to keep trading this chop where anytime the world doesn't end, you're going to the markets are going to rally off the lows intraday, right? And so, until something really actually does happen that in a meaningful way that would send the market lower, you gotta if you are trading intraday or trading weekly, you gotta be able to trade that chop, because when you get if the market's down 5 days in a row, for example, and first it's okay, First Republic Bank survive, they're not going bankrupt today, and then the market's up, you get the S&P up 2%. Well, it's been down 5 of the last days, so if you were short, you should have covered some of your shorts into that before the news got released that the world didn't end today, because not every day the world's going to end. One day, you're going to have one day, maybe you might not get it, but maybe is when you'll get that, breaking headline or that breaking event that actually does meaningfully send the markets lower. But until that happens, any day where you might be running a negative news feed for 2 days straight or 3 days straight. And that first day where, okay, like you have the authorities working to resolve the situation, or things are, the world didn't end today. Things are not as bad as expected. That's where you're going to get a short-term pop.
Yep. And this is your bull and this is your bear. That's the way I would take these markets right now. You can't take people seriously right now that are sitting there, doing charts like this, guys. Like it's honestly misleading and ridiculous. Like you got people out there calling for 7,000, 8,000 SPY. Like I think it's the stupidest shit ever. I'm just gonna be real with you guys. Like I think it's very misleading to the general public. But this is your bull thesis right now. And the reason for that is I want you to understand is it's that restrictive credit line, right? That restricted credit line is only going to get tighter and tighter the longer these rates remain high. The only scenarios is 2 scenarios that the Fed starts cutting rates. It's one that we are at 2%. I'll secede at that point that we are not going any lower, and nothing breaks. 2 is that something breaks. We will then hyper decelerate to the downside. If something breaks, you're going to see a deceleration in inflation, probably all the way back down to negative numbers. And that's what will send the markets significantly down. Do you have something to say?
That's fun. Yeah, it's funny you mentioned that because, again, like one thing to not misinterpret is that the environment's like disinflationary, because inflation's not, the CPI is not going to come in negative, at least yet. Right. So if CPI goes negative, that's where like we're experiencing downright like deflation. And so, for example, the CPI went negative in like 08 or 09, right? And that's like downright deflationary. And I've been wondering in my head if we do get to that point. I'm not sure if we do, but
if money gets restrictive enough, I think it's a possibility. And I think with the cap on the market, especially the SPY has been very indicative of showing that cap being in this zone. Anytime money gets above this zone, they basically shut it back down. That's that. I had it at 4,100. I got it at 4,080. Or if you're looking at a normal or another SPY chart, it's 480.
Right.
So when you're looking at this position, it's just money here to me is getting sucked out and not really coming back in. And I know some people are like, oh yeah, it's coming back in. Look. No, I think this is retail coming back in to get chopped back down every time. And we're seeing lower highs, obviously, right? Something we should pay attention to. And the bulls are only looking at the higher lows. But this right here is, this is a very good shape here that people should really pay attention to. Sorry, I'm having a brain freeze this morning. But this right here is a bearish.
I think it looks like.
Move.
I think
it
it looks like.
That's what it is.
I think it kind of looks like the way ARK did back in, like this back in like 2021. If you go look at ARK real quick.
Yeah, but this pennant, I'll look at ARK in just a second. I want you guys to understand, you can look this up online. Just look up a pennant, right? It'll give you a bearish scenario and a bullish scenario for pennants. This is a bearish scenario. And the fact that it's on this high time frame and has had this much consolidation, it really makes me think that this trade's going to really come down, right? This is not a good look. Like if you take the high to the low, again, which is typically what we're looking to do here. And let's say we drop over here, like this is some really big drops, right? And it doesn't mean that the market's going to go straight down. It's going to obviously do the same thing it did here and work its way down to a lower position if this were to play out from a pennant perspective. But let's go look at ARK real quick. Which one? ARK?
ARKK.
Yeah.
It made like a similar type of attempted like consolidation.
I think I have it on here.
Just type it in.
Yeah, I know. I just need to.
You need to get that organized.
I have so many charts, man. I'm looking at. It's crazy.
I have it all. I have it like organized by sector and country, and
I have some lists. I just got to clean. Yeah, I got to clean it up better. Like I have my stocks separated on my YouTube, and then I have my hot list, which is a lot of cryptos and stuff like that.
So look how long that thing went, sideways up at the top like that. It made like a V, it made higher lows. Yeah, I'm not saying that you're going to get a decline like that by any means, but you had like a similar type of consolidation pattern.
Yeah, that's all that's all it is at the end of the day. For those of you who don't know, this is called a consolidation pattern. And a tightening consolidation pattern after a big drop typically tends to become another drop. Now, really, the reality is if ARKK was healthy, this is probably where it should have stopped. But you know, it pretty much fell all the way back down here to these 18 lows. So it's not looking too great.
That was the craziest thing ever. I couldn't believe that happened because I bought it at $34 back in 2020. And, you know, once I saw this ship sinking, I sold like, because I sold like a lot of it on the way up, and then I sold the remaining, you know, I sold some at like, I sold like a clip at 100. And then I was like, okay, this thing's actually going to go down lower than where I bought it. I sold like the remaining amount at like $45 or something. And it was just like crazy to me that it actually went back. It literally went back down to like, it literally went back down below where I bought it at during a financial panic.
Yeah, and you can see the bounce here. Like you got a bullish div, so it might start reversing and going back for this high. Right up here. So that's something to watch for too. Could move back into that zone. But this isn't something I'd buy. ARK buys a lot of trash, to be honest with you.
They have a lot of what we were talking. They own a lot of profitless companies.
Yep. But you can see over here too, like you got some deviations. You got some different things on the chart that are kind of indicating this low here. That would be kind of like over in this zone. So we've got this strong trend, which is where we bounced. And you've got the bullish div here, which is where we bounced. And so this could be looking for upside. I think it's kind of sitting in a bull flag to the downside here too. So there's a lot of things going on with this, indicating that it wants to climb, but it's just a matter of how long will that trade work out for them, right? There's a lot going on here. But yeah, like I honestly wouldn't trade this, but yeah, this looks very much like the SPY up here.
That's more so what I was. Yeah, I mean, that's more so what I wanted to point out. Like more, it was just like it is pretty similar.
Yeah, and again, nobody's indicating, guys, that SPY is going to do this. Like, don't misconstrue what's.
Yeah,
what we're
don't
talking
misinterpret that. I was more so just looking at the consolidation, but yeah, that's really all I got. If anyone has any questions, I'd be happy to answer some real quick. Or if you have anything you want to ask before I head out.
Let's let everybody else jump in. Anybody else have any questions on anything that we've been discussing or might have been confusing for you? Everybody's good? Is everybody?
Yeah, we're still here. We're good.
Okay.
We went through a lot. It's good. There's been a lot on my mind, so I'm happy we got to catch up.
Yeah, it's always good to conversate and talk through it so we can understand different perspectives and so on and so forth. I think that's really good to kind of keep an eye on.
Yeah.
But yeah,
well, cool. I appreciate you having me on and taking the time to talk through all this.
Yeah, Aaron, we miss you,
Yeah,
Aaron.
that's great,
I miss you too, Aaron. Yeah, I miss you.
Guys, I miss you guys. I miss you.
Tuesday schedule.
Yeah,
Now,
Aaron,
I mean,
we miss you on Tuesdays. Like we need more macro over there in the circle.
We'll figure.
Black sport hat.
Yeah, we'll figure some out eventually. Right now, I've been kind of taking a little bit of time away to like take some time for myself to work on a couple of things, but we'll figure some out eventually.
No, we got Will to help out too. You know.
Of course.
Yeah.
Oh, we're gonna
right,
keep going, guys.
Yeah, no, yeah.
Okay,
I'm just gonna I'm gonna
Aaron.
hop off. I'm at my grandmother's house, so
All right, man.
I'll catch y'all later.
Appreciate you coming on.
All right, bye, y'all.
All right, see you.
Appreciate it, Aaron.
I mean, somebody asked about sand. It's consolidating up here, right? That's basically it. You're kind of consolidating this upper zone. I think sand's still looking to trade significantly lower. To be honest with you, I think a lot of altcoins are. I think they're just kind of moving with Bitcoin, finding support in the current zones that we're looking at. I still expect these price zones to be reacted to because we basically broke below, the real resistance / support. So I'm expecting, even if they can trade back up here, I think this thing's looking to reverse. Yeah, there's so much going on, guys. Like,
So Will,
yeah.
question. So if you think they're gonna drop more, then we shouldn't be accumulating now, right? We should be waiting.
Yeah, so again, we talked about this. I wouldn't really be accumulating anything while BTC sits up here.
Okay.
Even if BTC were to go higher, and I'm wrong, right? I still wouldn't be accumulating anything. I would wait for a big pullback because even if BTC moves into a 1, 2, 3 wave, which a lot of people are anticipating, which is your A into your B into your C, or hold on, let me delete that. Did not mean to use that one. So it'll be your 1 into your 2 into your 3 into your 4 into your 5. I believe completely that we're going to see the same move right back down.
Okay.
So this right here would indicate, that most alts will trade significantly lower than where they already are, and that you'll be able to get a better price on Bitcoin and Ethereum.
Okay.
And it's the same thing over here on the E chart. Like if you're looking at ETH, we've got this kind of consolidation high. It's a very obvious range where they're sitting on the higher time frames, monthly, so on and so forth. And I really see ETH kind of really working its way back down to these lower zones, and trading much lower. If it doesn't, it doesn't at the end of the day. I'm just not interested in buying things that are elevated in price so much. If it's not able to do that, then I just won't be getting ETH. I can make money plenty of different ways. I don't care about a 5x, 10x, whatever you think ETH will go to on, like altcoins will do significantly more. I'm not telling people to buy trash because that's what altcoins are at the end of the day. It's why you should always unload them when they pump. But what I'm telling you is like risk to reward, right? You're making more money in risk than you are to reward, and I consider altcoins a lot of risk. So there's a lot of reward to be had in them. Yeah, Ethereum as a whole is on an uptrend. The only thing that throws me off is this portion right here doesn't really follow trend, so it makes me wonder if this trend is true. In which case, we trade significantly lower, and I was wrong, and a bottom forms on Ethereum, and maybe it's something similar to like this, right? And then all this right here was just noise to move into the lower price, and then the next bull run, boom, probably happens at a much lower low for Ethereum, in my opinion. I think BTC has potential to double bottom, whereas Ethereum has good potential to trade significantly lower than where we went. And that along with the altcoin market. One thing I wanted to point out too, and we're going to be talking a lot about crypto, because a lot of people in here from crypto and stuff like that, is we've discussed this many times with the market. Again, watch your market cap, right? We dropped down to 1 trillion. We shot back up to 1.15, right? We were at the same market cap when altcoins were running, when Bitcoin was on the floor. Think about that. This is an asset rotation. It is not new money coming in. Money was created in altcoins. That money was then sucked out of the altcoins and put into Bitcoin. Does that make sense to everybody?
Yes.
Market cap growth has not been significant. It just hasn't. So don't get fooled by what's going on in the markets based off of Bitcoin up. The market cap is telling us different. It is telling us difference. It's telling us that this is a rotation, not new money. The money got sucked out through the alts and put right back into Bitcoin. And now it's getting sucked out of Bitcoin and might go back to the alts. We'll see. We'll see what they're trying to do with the money. So 1.2 is kind of the key. And we talked about this too. Look, we can pull this up a million times, and I think some of you will still forget it. If you are confused on what's going on in the market, then it's very simple. Let's see. Come over, hit your totals, right? I think I have totals on this one. Nope, it's going to be on my other one. Come over to your totals and look at your totals. That's all it is. It's not difficult. Right here, let's go total. This is all of crypto, all of that's Bitcoin, that's Ethereum, that's everything. All right. Go on the monthly. What do you see? Let's clear the whole chart. Let's go ahead and go across here. What do you see?
We're not the resistance.
Channel, on the upper channel.
We're on the upper portion, but what is going on with price?
It's consolidating.
It is consolidating. Are we in the upper range or lower range?
Upper.
We're
Upper
upper
range.
for now.
We're in the upper range. Do you buy in the upper range or do you buy in the lower range?
Lower range.
range.
Lower ranged. Okay. It's not a hard game to play. Don't make it more difficult than it has to be. If you are confused between alts and Bitcoin, just simply open a total chart. There's nothing happening in crypto. There's no reason for people to be calling for 500K, 150K, $1 million Bitcoin in the next 90 days. Bitcoin is literally consolidating sideways. Well, not Bitcoin, but the crypto market is consolidating sideways as a whole. And we just rejected out the high. Now, hey, let's go with a bullish thesis. Let's say we're bullish, right? We want to be extra bull, so on and so forth. Then we look for a retest of the middle. Right? That means that crypto as a whole will be sitting at what? What will it be sitting at? 943 billion. That means how much money got soaked out of crypto if that happens?
Well, it's not gonna be sucked like you said. It's rotating, right?
About 2 billion.
About 250 billion. Because we were at one point at the high here, sitting at about 1.18 trillion. Right. So it's 220 billion if we end up right back down here. And when we say sucked out, it means that the money could rotate back in or it could just leave. Because when the money comes all the way down here, where's that money going? When the total comes down here, where's that money going?
Back to stocks.
Yes, it's going out of the market.
It's going out of the market. We don't know if it's going to stocks. We don't know if it's going to gold. We just know it's going out of the market. That means that it is not in stable coins. It is not in crypto. It is not in anything. It means it was completely removed from the market. And then we can then see that inflow again, right? We could see that inflow again, but we have to wait and see if that inflow will continue to play the game. This is the
Could you
lower end of
please
the range.
post this chart on Discord, Will?
Yeah. I can take a snippet of it and throw it in there for you.
Yeah, just so I can get the ticker of it.
And then if you look here too, here's your halving. What did the whole crypto market do just before the halving?
Dropped.
Did we miss the bottom?
No,
Doesn't look like it, does it?
Looks like we're
Alright.
trending sideways like you predicted way back.
If we come over here and we look at this one, let's go 422 days from the halving.
Sideways.
Oh, look at that. We're going to the moon, guys. But what happened before the moon happened?
Retest.
I'm just saying, because I know some of you are going to be like, well, this is COVID. That's not COVID. Did we miss the bottom?
No, just accumulating.
No, look. This is the body candles. Wicks are invalidation, right? They're just noise. The agreed upon price is the body. We came back and retested the body. We came back and we retested the bodies, the lows.
well, what's that indicator?
The halving one?
Yes, sir.
Just
Okay.
Bitcoin having this one's Bitcoin having shadow past dates. So
Thank
if you're looking for the one that'll tell you where the current halving is, that's Bitcoin having UTC countdown. It basically is it's looking at blocks and it's paying attention to how many days per block, and it gives you a guesstimate on how long until that halving. Now this is a little bit off what it says, but what you can do is you can just drop a vertical right at the point and then remove it and then take a measured move from the current day all the way into it, and you can see how many days you have left. 420.
Yeah.
We have time.
Again, don't panic. You'll be fine.
Sound like the government.
Even if Bitcoin trades out, I'm okay with that. I'm okay with that, and I'll probably play the moves if I see it. Let's say Bitcoin trades out. That's fine. Bitcoin traded pretty high here too. Still came back and retested before it went. Always keep that in mind, right? Yeah, I mean, this is what I do, guys. Like I literally have to. I come up with a thesis to show you guys kind of like why I'm not worried. I'm just not. I know a lot of people are, but there's no reason to be. Go ahead, smiley face or straight face.
It's actually Tad's, but yeah. So it's my phone
You're
picking up
good.
like that. I'll come up as all weird stuff because so many devices. Would it, without overcomplicating the Discord, would it be possible to just make maybe a sub channel or a channel off the TA just for indicators, and we don't chat in it? We just sort of put indicators that we use.
Yeah, we could throw some in there. I think that
Or is that just going to confuse things more?
I think it will confuse new people.
I think I'm confused too.
Yeah.
No, that's fair enough. That's fair enough.
I have no problem sharing with you guys what I use and stuff like that. I think you should keep indicators to a minimal. The only reason I use the halving ones and the UTC halving, because I keep on seeing these people, these narratives, how Bitcoin's gonna go from here, to like there, and like at that it's just going there straight up. And I can't stand that kind of shit because like they're historically, if you follow and they say this is historical when they do these kind of charts. Historically, if you follow Bitcoin and you follow the crypto market, it tends to come back and retest.
Yeah, they try to argue that the market was moving up before 2020 happened, but I think the market knew that 2020 was going to happen. Like they knew the pandemic was coming, so they drove the market up a little bit to make sure that they could get a good short in or something. I mean,
they drove it up to create that buying pressure so they could sell into them. And then once they get that panic going, and that panic, I think for retail occurred right below here. Look, and look. And then as soon as they got priced back to here by retail selling it down, they then flipped it back up. I know it seems hard. It seems like, well, what if I'm wrong? What if I'm wrong? What if I'm wrong? What if the sun explodes tomorrow? It's a lot of what ifs in life, right?
None of this matters then, right?
None of that matters. Just follow what's actually going on and follow historical patterns as far as crypto goes, right? And I do believe that with regular markets too. And I think the downfall of the regular market will be that pullback for crypto. It just don't panic and miss it. That's basically
one thing I keep reminding myself is that we're still technically in somewhat uncharted territories because we've never seen this whole Bitcoin has never seen a recession before. So we don't know for sure how it's going to react.
Correct. But
that's great advice.
Just fear, uncertainty, and doubt. Okay. FUD. Yeah. Fear, uncertainty, and doubt. Don't doubt the process. Don't have uncertainty. Just follow the protocol. And I'll tell you this: if you're a crypto bro or you're a crypto, crypto girl, whatever, just follow the process. If you have, if you think that markets can trade substantially lower, and you feel that this is not a safe asset for you, and you wanna play catch up, there's always a way to catch up. Always a way to catch up, right? There's always something that hasn't moved. There's always something that you can get into to catch up to you being behind because you wanted confirmation. There's no reason to ever panic into a market. There's just not. And that's what I try to teach you guys on a regular basis. That's what I try to teach people on Twitter. Look, I have right now, I think almost 1,800 followers, right? 1,800 followers. I'd say probably 100 of them just like to argue with me because with no substance, by the way. I'd say 1,700 of them look for information, ask me, and so on and so forth. And I would say I come in here on a regular basis and provide this meeting for you guys for free. And typically I'm looking at an average of 30 to 40 of those 1,800 followers showing up. Can it be disappointing that many people don't want help? Yeah. Do I think that everybody's in the same time zone? No. So I'll give the benefit of the doubt to maybe like 30 people that listen to the Q&As after the fact. But this is the problem with influence, right? People want fast money. Those of you who come here, I try to provide you substance. I don't try to provide you FUD. I don't try to provide you hope, because in this market, it's cutthroat, right? There's no hope for the hopeful. There's only numbers. Follow the numbers. As much as I would like to see everybody in the world succeed, it's not a reality, because you creating wealth is essentially a sleight of hand of somebody else losing wealth. Does that make sense?
Zero-sum game, right?
It's a zero-sum game. Somebody has to lose for you to win. And this is the rotation of life. This is how the rich become rich. They become rich because they step on others to take wealth, to create wealth. And you may be like, well, that's messed up. I don't want to be part of this. Anybody can do it. It's just a matter of educating yourself to the point to where you're able to do it. And this is why you have to be broader and expand your mind. Believe me, guys, like if I just wanted to trade charts, I could do that all day long. I could do it all day. Not an issue. Not an issue. I could trade price all day long. But I've been expanding my thoughts, expanding my understanding of the finances, the financial system, and so on and so forth, and digging in deeper. I want to know more, right? And you need to have that adventurous mind to be able to withstand, downturn, to be able to withstand upturn. I mean, all of 2022, I did really well, guys. Like, yeah, I told you guys down, 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 down. It did exactly that, right? And everybody else in 2022, up, 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 up. All this bounce, it's going to 100K. This bounce is going to 100K. This bounce is going to 100K. And then you get consolidation at the lows. And hey, we're going to like 5K, 3K. And then you get a pop. And now we're going back to 100K again. You can't react to those type of things. You need to be grounded. Stay grounded, right? I know it can be difficult, but just it's something that you have to do. And I think it's possible. We're all adults, right? We're all adults. I just want you guys, and I have to come up, keep in mind, I have to come in here on a regular basis and not necessarily argue or any of that stuff from my position, but I have to come up with a realistic view for you guys to understand. Even though I know this, I don't even have to draw this out in my mind to understand what's going on. But I have to show you guys so you understand. And hopefully in time, you're able to identify these things. That's really the purpose of this meeting. It's not to come in here and gloat. It's not to come in here and, so you guys, hey, I know exactly what's going on or anything else. It's think outside of what people are telling you. Don't follow the narratives. We talked about the news, right? And them sitting there talking about bank runs are because people are telling people, be fearful. The banks are going to run out of money. No. Bank runs are happening because people are seeing opportunity in other assets to put their money and make a yield. But if you come out and tell the public that, what's everybody going to do in the banks?
Lock down the money, right?
Take their money.
They're going to take their money and they're going to put it in a yield. And they're going to be like, shoot, why have I got my money in the bank? But rather than tell you that, the truth, they want to tell you everybody's fearful, but don't panic. Just leave your money in the bank. You'll be FDIC insured. That's because they want you to keep your money in the system. They want to make yield on your money. And we talked about earlier, keep in mind, and we said, and I didn't go into depth on this, but money on money on money, right? A yield being loaned out and loaned out and loaned out. Let me give you an example. If I go to the bank and I take out a $10,000 loan at a yield, and then I put that and invest that into a company, and I give that to them at a percentage loan on a yield, how many layers of borrowed money have we got there? Two. Keep that in mind, right? 2. That means that money has doubled in the system. Essentially, it's accounted for on me, and it's accounted for on the person I loaned to. It's 2x leverage. If they default, then I default, then the next person defaults. That's how the system is created. That's the Ponzi of the economic system. And this is how wealth is created, because if you can get more and more people to borrow the same loan, you've now got a Ponzi. Because although 40,000 looks like it's what's being borrowed on paper, only 10,000 exists. Does that make sense to everybody?
Yep.
So this is why restrictive credit lines becomes a real issue for free flowing money and economic growth. When people state, oh, well, people have all this money. Some people do. Most people don't. All right. So getting into total, we just discussed it. We got a perfect rejection at the high, right? And then we're coming back. Where else did we perfectly reject at the high? Oh, look at that. Perfect rejection at the high. Except this would have been here to here on total. So now I'm looking for at least from this position, I'll pull back to the middle of 936 billion. That's going to be pretty bad. What will that mean for crypto? Remember when I did the IVB, or sorry, the IHH, the inverse head and shoulder, or IHS, the inverse head and shoulders on Bitcoin? Now let me give you another scenario. Do you see it? I'm giving you the second opportunity here. Do you see it?
945 billion.
No, it's okay.
I think it'll be somewhere in there.
Have to mute.
You guys see what's going on, right?
It's completing the S curve.
Inverse head and shoulders. Right arm, left arm, center. So when the market pulls back to here, what should you be looking to do?
Buy spot.
Buy a spot. Because we're not longing a bear market. It's not going to happen. But buy a spot. And we could remain elevated here for a while. Keep in mind, we could do this before the second shoulder breaks and goes. That's what I'm watching for. What's up?
Sorry to cut you off. the timing, the length of time it stays up on the upper channel. How could anyone predict how long it's gonna stay up there before the drop?
Well, they can't. That's why you should not be buying up here.
Okay, yeah, it's
You see what I'm
I guess
saying?
You have to wait, you have to just keep waiting until it
Yeah,
drops.
this is a patience game. Look, are you trying to play this chop with
Oh, no.
low relative return or low relative pot, or we'll say possibilities percentages, right? 'Cause
OI.
your ROI is very low up here, right? And not only your ROI, I would say like your percentage of successful trades will be much lower up here. Your percentage of successful trades will be higher on the retest go.
Can
Much
you zoom
higher.
out for a moment, Will? Just zoom out a little bit. Yeah.
And you have the same thing up here. Look. Now, granted, this actually needs to go all the way down there, but
Yeah, look at that. They do the same thing. That's crazy.
similar situation.
It's the same sine wave.
Mhm.
The frequency.
And if there's going to be a consolidation and this ends up playing out, that means Bitcoin could come all the way back up here and then probably lead back down with resistance from here into a pullback, probably as substantial as here before it breaks out. Going in, and now I think all this will play more into the halving, right? So we come back, probably chop side, or we can even chop sideways here until the halving, and then maybe even come back and revisit these lows before we end up moving off of that.
It doesn't have to revisit the lows to capture liquidity down there, or they won't leave it behind.
Yeah, typically you're looking for a double bottom, something like that. It's the same thing they did over here. Look, same exact zone. So if they want to come back and they want to recapture, it's going to play this upper channel. And if it starts playing this upper channel, we're not going to see this inverse head and shoulders play out, right? But I think you should take the opportunity on the inverse head and shoulders on the market cap, let it roll back up. And if it rolls back down again, you'll probably get one more opportunity to get out and get a better opportunity to get in. Really, but I think if you're buying anywhere from here to here, you should probably hold those positions from here, right?
Gotcha. Okay.
And then going into the next bull run. But this is just my thought process on the IVB, and really this right here could end up playing out for a while and end up playing something like that, right? Or even like all the way over here. And maybe it doesn't retest the lows. Maybe it retests here. I mean, this is low enough to the lows to where they didn't really leave liquidity behind. Just like this right here was low enough to the lows to where they didn't really leave liquidity behind. Does that make sense?
What's 915 is about a 15,000?
Yeah, well, it all depends, right? Where is their money allocated somewhere else, or does it stay in Bitcoin, the money that has already been flushed in? So what I'm saying here is like Bitcoin's price will come down, but maybe Bitcoin goes to 18 or 16. Does that make sense? Versus the 15.
It does. And the altcoins we are looking at should be dipping way below that to grab another.
Yes, if that money stays in Bitcoin, those altcoins are going to get destroyed.
Yeah, well, Bitcoin's at 47.25 dominance. So
yeah. And this is what I've said before, and people try to argue with me on the fact is that Bitcoin would regain its dominance against the altcoin market, and that's exactly what it's doing. It is regaining its dominance. So,
Well, can you open dominance BTC monthly?
Yeah.
Well, when you say people arguing, is that people in here or someone else? Because I don't see.
No, when we were like in FS and stuff like that, people were trying to tell me, "Oh, yeah, it's never going back to 50."
That's a different animal over there.
I was just like, okay, we'll see. Let's see.
We might pull out of this thing the same shape as like the optimism chart.
Yeah.
That's true.
So here's and you can see here, I haven't touched this chart. Where are we sitting at?
47.61. Yep.
This was the exact zone I was looking for. And now I want you guys to understand that when price broke to here, my thesis was at the time, and we were trading much lower on dominance when I drew all this out. My thesis was at the time, when we hit here, there'll be a market crash. And that'll be also will be dropping harder than Bitcoin, but Bitcoin will also be dropping.
That was back in December.
It was a while ago. And
Yeah,
you can see
December.
the rising wedge here on the stochastic, which looks like a breakdown pattern. And you're now moving into that overbought territory for BTCD, which looks like a fallback position. So maybe watch the 50% here on the RSI, and that'll probably be your fallback. And I think that support probably lies somewhere around 43.54 or 44. That's Bitcoin and the altcoin market getting drained, and then a bounce off of that to break out to these upper zones. This has been a heavy resistance for a while, guys. Like it's something that's got to break. It's the same thing as what happened over here. It's just taking longer to play out. And this was your 1-2 move out. And then once you start getting up here, like these are your bottoms of your markets, more or less. This is like your 18 into 19. Once you get above here, like if we go 18 into 19 on Bitcoin, let me show you that location over here. So you got your 18, right? Going into 19. Where are we at? Where are we at? We're at the bottom. And where's BTCD trading at? Above the 50.
Yeah.
That's why I said this zone is detrimental for the market, because you could see a massive dump in this zone, because that's historically how it's played out. So something to watch for. All right, let's move into some other things. Oh, let's talk about, so we talked about SPY a little bit. And I keep an eye on this again, because I think this is kind of your signal, right? This is your signal. We got support here. And again, it's just all about identifying, right? You got support and then a breakdown, no follow through to hold support above here. Then you get a move up with finding support into a shift up into a drop back down, right? So we're getting some pretty bad signals here. Then you're getting a move up, a retest of the support, becoming resistance, a move down, a move back up, can't hold that resistance like we could over here, and now move down and an attempt to come back up in a full-on rejection. I think the SPY could really fall over in like a month or two, the way this is looking.
Rising wedge follow through.
Yeah, this is a this is one of the worst patterns you want to see out there, a big downtrend.
Like, textbook dump, isn't it?
Yeah, no problem, Ray. Yeah, this is a textbook play, and I think what Aaron brought up with one of these, I forget which one it was we were talking about earlier, but basically it looks very, very similar. I think it was ARK, right? ARKK, yeah. So the ARK play looks very similar to what we have going on here. Do I think that it's going to play out like hell no? I don't think the SPY is going to dump $1,000. I just don't. But I do think there's a possibility that, you know, this, and a really good one at that this ends up playing much lower, right? And you can see here the initial dump led into a support over here, right? And that's really what I'm looking for SPY, is to do, and that's probably the same as the measured move from here to here. So if we take the measured move straight down into the lower zone and then kind of play that out there, it's pretty much exactly where it should have fallen to. And that's why I'm saying like the SPY over here is in a fairly similar situation to where I'm thinking like we go straight down. Yeah, well, this one's bad because it comes all the way down to here. I'm not liking that, but let's try and make this a little more something like that. That way I'm not looking too crazy here. So that's your drop. And then if we take that from the measured move high, that's your straight down move right there. That brings us almost into that 3,200 SPY. That's pretty crazy. Would I expect to go deeper than that? I hope not. I'm not going to tell you guys it is because I don't think it is. Could I be wrong? Sure, it could keep on going. But I'm not a masochist at the end of the day, right? I don't wish bad will on anybody. And I think if we broke 3,200 and went deeper, like this is gonna get really nasty.
Over 2020, like it's going to land on.
Yeah, if it were to do that, remember ARC? Remember how we just looked at ARC? Remember that trend I just showed you right there?
Yeah.
That trend. Let me show you something on SPY. It's really weird. How they look?
You do not want that.
Ouch.
Well, cheaper assets, right?
It is, but this is really bad if that happens, man. That's I know I'll get wrecked in this 100%, and I think a lot of people would get wrecked in this. Like this is like some Great Depression type stuff in my eyes, and I can't see that. I just can't see that. I just wanted to show you kind of the relation between the two. I think this is low as it goes.
Lagging.
What's that?
It's like this is more volatile but lagging.
Yeah, I mean, look again. We'll do the
Scary
ARC.
as hell.
That's your drop, your consolidation, and then you pretty much just full on fall out right to the lows, and you hit this lower angled zone right here. Come over to SPY. Look, sideways consolidation, just like ARC, lower lows. And if you were to hit it, you would be, oh my gosh, I couldn't even imagine the markets, man. You're talking about like people going from billions of dollars to being worth a couple million. This would annihilate the market if that were to happen. Again, I'm not a masochist, so I don't think that this is even a possibility.
Yeah, I
in the
don't think they'll
cards.
let that happen.
But I want you guys to understand that the patterns of SPY and the patterns of ARC are very similar, right? So just keep that in mind. So if ARC can do this, and I'm not saying ARC runs the marketing, again, it runs a lot of high leverage trash. That's what they run on. These like ARC's portfolio is all high yield growth. Like it's just dumb, and this is why they're getting annihilated. They have no defensives at all in their portfolio that I've seen. Maybe a couple, but
age of monopoly, absolute monopoly there. If we dropped all the way down, only about 2 companies would survive.
yeah, that's what I'm saying. Exactly. I can see Facebook getting wiped out and something like that. I'll put it that way. Like
I wouldn't cry.
Facebook would be the next MySpace. I don't know if you guys remember that or not, but
That sounds awesome.
I think Google would remain. Amazon would more than likely remain. There'd be certain ones that, and the reason Amazon will remain because they're AWS. But it would annihilate most of the country's businesses if that were the case. They would go to zero. Again, I'm not anticipating these type of moves. I just want to show you patterns, right? Patterns tend to reflect each other. They tend to all play out the same way, and that's what I'm seeing in a lot of these stocks. Is they're all playing the same patterns. And this is a very bearish pattern. Again, not trying to upset the bulls if you guys are bullish or anything like that. I'm just trying to show you guys reality, right? Now, let me give you another scenario. I'll give you an invalidation, all right? Because there's always an invalidation. If somebody says they don't have an invalidation, they're stupid. And I say that because, and I don't say that mean like an ignorant response, they're stupid. I say that more in the factor that you need to always have an invalidation to your thesis. Otherwise, you're just being biased with your position. So my invalidation for my thesis will be anywhere above 42.72, right? If price were to move up to that 42.72 and break above and retest somewhere around 4,500, I'm wrecked, right? On a lot of my puts. And I'm completely invalidated. Now I want you to understand, you're probably like, well, then you would have missed the whole move. No, I wouldn't, because if it hits this, it's going to come right back down, retest before it attempts to move higher, right? I can get in on the retest and play the upside from there. I'm not worried about chasing. That would be my invalidation. Just so you guys know that I have one. I know it's extremely high, again, because we got a double top here, right? But we would expect that, sorry, excuse me, that price would come back down and hit these lows as support, if not lower on these supports, right? So you would be looking for that reversal move somewhere between here and this upper zone here. So that's where I'd be watching on the higher time frames. I'd probably cut it down to a smaller time frame if we ended up doing that kind of breakout, and look for that move where that pullback's going to occur and take the upside for the market from there. I'm not worried about missing out, guys. I'm just not, and you shouldn't either. But like, I understand some of you are. But if you're worried about missing out, this is not the market to be in. It's just not. I know a lot of people tell you can get rich in these markets. You can get poor just as quickly as you can get rich in these markets, just by making the wrong moves. So, and I'm just being realistic. Again, because somebody has to win, somebody has to lose for somebody else to win, and you could be that. You could be on the losing side of that trade. If we look here for 2 year, again, I haven't moved anything. We can see right here they pulled a little bit below the low here, but then they pulled price right back in my zone, and you can see they hit the high end of my zone perfectly. And as you've been around, this has been up for over a year. I've been calling 5% SPY since all the way down into here at 1.4. Because once we broke above here, or not SPY, sorry, 2 year. Once we broke above here, I already knew where they were heading with this. And that's with this all the way over here. They were going for that liquidity. Yeah, there's always a fake out before the directional move. Exactly. The fake out is to intentionally entice you in, then get you to sell the bottom of the move, and then you have to chase from there. So never, ever, ever chase. Like, wait for the pullback, take the validation to the direction you're looking for, and then follow price from there. So my anticipation is that if we get a decelerating environment that becomes ridiculous, we could see some really, really harsh bond buying, right? If we see that bond buying, we're coming way down on bonds and percentage yield. And I think the support will be around here. That'll be a higher low. And then, that could play out in and you can see this is like some years later. 2025, 2026, we didn't see that reversal move back up. That's your sell-off of bonds, risk back on. And then we kind of roll up from there. But usually the risk trade usually tends to happen midway through the drop in bonds. So you're looking at you get your drop initiating up here, and then somewhere's halfway through the move, you start to get your risk on, right? And your risk continues to buy as bonds continue to buy. And then they start to reverse. You get the consolidation low, just like down here, and then starts to reverse. And then you get the sell of assets somewhere between the middle of the move to the high, right? So that's what you have to watch for, is that reversal move, because you can play risk at the lows all day long, but once that move starts to reverse back up, you need to start looking for sell positions. And that's where I kind of watch the market as a whole. And I knew that once we get above here, this is done. And we got into August, September, October, and then boom. And then 2022, again, the mid-range, right? The same mid-range that it started buying is the same mid-range that it started selling. And then it was just a massive sell-off until we hit the high up here. And now we hit the high on bonds. And now we're kind of looking for that reversal move. And we're going to get a big selling event into the mid-range, and then a big buying event in the mid-range, and then a drop back down that continues to buy, and then initiation of selling over here, and then the big selling starts to occur here, and then you get the big sell-off until you hit the next resistance high for bonds. This is how I read bonds from a chart perspective. The bond market kind of yields and tells you what's going on ahead of time. It's just the bond market tends to play the middle of the move. Good.
Hey, Will, how the interest? How's the interest rate in the bonds right now? The yield.
I mean, the yield right now is 3.774. It's still very enticing for a lot of people. With the way that things are set up right now, you can't really earn a yield in a lot of things because of the interest rates. So people are fleeing the bonds so they can continue to earn yield.
So it's not safe then either.
No, it's safe. It's safe.
Okay.
Because it's guaranteed money, right? It just everybody else, including banks, are substantially lower in yield, so they're not able to keep up, and that's why you're seeing these bank runs on banks. It's more about the yielding than it is about fear of liquidity. I think fear of liquidity might be some, uneducated retail, but most big money is looking at, am I making anything in this or am I not?
Okay, well.
Yeah.
So
So
you mentioned something last summer. You mentioned something about the bonds on the Saturday recording.
yeah, and that was something I was watching heavily was the bond market, and that was my indication of the downside of the market too at the high. Was when the bond market started making moves. Once the bond market starts to sell off, risk is pretty much off the table. You're going to start to see that rotation, and as yields go up, that's the bond market selling, and then you're going to see assets start to sell with it, and then you're going to see the bond market buying, and you're going to start to see risk assets start to buy at about midway through the move of the bond market buying. And then once you hit the low of your bond market buying, where you kind of consolidate and you're not really getting any more buyers in the bonds, that's because you're getting the FOMO in the risk assets. And that's where risk assets are at their peak, is at the low end of the curve for bonds. And then once bonds start to veer back up, you'll start to see a sell-off of risk and a sell-off of bonds together, and then they'll hit their high and then continue the pattern. Like this right here was your market high on all assets, and you can see right here it follows perfectly. You got your March 20, which is your big drop right here, all the way down to the low. You get your consolidation low after March, and this is where assets started to bid really heavily. Your high-end FOMO peaks, and then you push all the way through 2021, which was really rampaging bull market, and then you start to get the bond market sell off, which is indicating we need to start looking to sell off our positions and reallocate into cash and hold cash until we get to the high end of the range. And then once we get to the high end of the range, again, indicated from previous market high, we're looking to start allocating into assets, right? So this is your asset range. Now, can this predict exact bottoms, exact tops? No, but it can predict you really close to where your top is and where bottom is. Again, if we look at it from a perspective of when the bond market started signaling, it was like right over here. Going all the way into over here. And this is how I knew the market was going to continue in a downtrend. And this is why the sell-off over here made sense, right? And then you had, this is also why the market flipped at 30K, because the bond market wasn't quite out of that zone. It was still willing to take on risk. Going into the end of the year, though, that risk started being taken off the books. They started removing that risk by selling bonds. Raising bond percentages, and then once you start to see bonds move out, you'll start to see assets start to sell off with it, and we're starting to see that move down, move back out, and now we're kind of at that top end of the range for bonds. So bonds are kind of signaling, hey, we might be topped here. So because bonds are signaling we might be being topped here, it means that we need to be looking to allocate. Even if price can go deeper, we need to be looking to allocate, but we're not looking to allocate the pumps. We're looking to allocate the pullbacks, right? And that's really what I'm trying to tell you guys. It's like be patient right now. Again, SPY is indicating something bigger to me, and really that's because we've only begun to see buying in bonds, right? Where did I tell you the move tends to start in bonds? It tends to start about midway through the drop, right? So maybe like somewhere's in here or somewhere's in here will be the bottom. And you can see that over here. Here's our 2007 to 2009 bond buy up. So they basically just bought, bounce, bought, and this was the bottom of the market right here. Bonds continued to buy, consolidation, bull market, and then boom, we're back off to the races.
The bottom of the market could be 22K, can it?
What's that?
Bottom of the market can be 20K, not a 12K.
Could be 20K versus what are you talking about for Bitcoin?
Yes, sir, for Bitcoin.
Yeah, like I said, anywhere. So I'll just give you kind of a float, right? So let's say anywhere's in here, you're looking to allocate. I know it's a big box, but that's again, if we were taking by level, you could take this level, you could take this level right here. You could take next level down being like right in here. If it goes lower than that, so on and so forth. This allocation level right here is based off of this right here. See those two white candle pullbacks? That's basically where they try to hold price inside of that zone.
Understood.
So if you end up back in that zone, that's a buy. And then if you end up breaking that zone, your next buy is down here.
Yeah, I'm just going off the other post you had done about you might have missed it.
Yeah, so that it would be the same thing. If you look here, the high end of this range is what price?
About 19.6.
20,000. So 20 all the way down to 12. If you want, like I said, if you want to take levels, do 20, breaks that. You know, you're looking at 19, breaks that. Look at 16, breaks that. Look at 12.
Yeah, I would never look at BTC to buy. I know the odds will be cheaper, so I'm not worried about it.
Yeah. Yeah. If you're looking to buy BTC, like me personally, I'm looking to allocate altcoins to create wealth. And then if I'm looking to sustain, I'm buying BTC to sustain.
Understood. Thank you.
Mm-hmm. All right.
What doesn't BTC go back down again?
I'm talking about where it's zoned at right now. Right. And BTC sees significantly less losses than any alt. So you have to look at it from those perspectives. Again, create and to hold wealth.
As opposed to a stable coin, you put it in BTC.
Are you talking about? So
Something like that, right?
hold on one second.
No, you were saying to get all coins to generate to make the money and then put in BTC to I can't remember the word to use to store it or whatever.
To sustain. So, but you're not looking to buy BTC on a pump. You're looking to buy BTC on drops if you're looking to sustain, right? And when I say sustain, I don't mean like the dollar wouldn't have value or the stablecoin wouldn't have value or anything like that. What I'm saying is like if you think you're near a bottom, you want a certain amount of sustainability to your portfolio, just like you want a certain amount of growth to your portfolio. You're good. You're good now. You see what I'm saying? I don't want you guys to get confused by what I'm saying, but like, so let's say I want to allocate 20% of my portfolio to sustainability. Then if BTC pulls back again, I'll buy some, right? That on that 20%. And then let's say I want to go 80. And again, I'm not telling you guys to go 20% sustain and 80% risk. But what I am telling you is like, I'm just giving you a number. But let's say 20%, I'll buy a certain percentage of that 20% on the pullback, pulls back again. I'll buy a certain percentage of that 20% on the pullback, pulls back again. I'll buy 20%, a certain percentage of that pullback on 20%. Now, if I get down to the 12K range, I might just go ahead and fill in the rest of that position on that sustainability position for Bitcoin, because I don't really see a lot lower lows from there. And then, and if it does, it does at the end of the day. If it goes 8K, it goes 8K. If it goes to 6, it goes to 6. But I'll find a way to get liquidity to add in at those positions if it goes that low. I'm not going to hope on a dream that it will. So I'm just looking at it level by level. And if each level gets completed, then I'm going to continue to buy in. So I'm pretty much all in on my sustainability hold on Bitcoin from here. And then I should also be looking to allocate my other percentages to alts and so on and so forth and have most of that sized in, right? You're trying to size into a position. That's all it is at the end of the day. If you're like, I'm all in here, it's the bottom, you're an idiot. Like I think a lot of people should size in. And I've seen a lot of people say that on Twitter, like, I went all in here. It's like, why would you all in anywhere? Like you need to size into a position just like you need to size out of a position. Where's your best place to size out? Well, it's where price starts to resist. You could have sized out right here in January and be like, hey, I'm out, and the market could have ran again. And guess what? You still got in cheaper. You're still cheaper than where you were when you got out over here.
When do you move to altcoins?
You can size on altcoins before the halving. Tends to be that's where the hype and everything will start to pick up a little bit. Now the price movements will be small in altcoins for now. It's just about being able to hold those alts through. And then once you get into the bullish portion of the market, it'll be obscene. I'm just it honestly, like, I watched $100 go to like $7,000. It's just stupid numbers.
So you're kind of DCAing in now kind of to some alts?
Yeah, I'm picking up alts right now. I mean, a lot of alts, again, we've talked about this, are setting 98% down or better. I mean, could they drop another 90% from the 98%? Yeah, but that's like what, 99%. What are you really gonna lose? These things are so wrecked, it's not even funny. Now, if you're talking about something that's been running, I think it's just stupid to buy something that's running right now when it comes to an altcoin, because those things can see significant downside. So if people are sitting there pumping like Aptos on Twitter or whatever, like for instance, this was one that was pumped really hard. Sorry about the blinding light. And now look at where it sits. People were pumping and telling people how it's going to go to $100. Now we're at 11. And I think it's going to continue down. I think it might even end up right back down where it started. So.
Yeah, ICP is at 92% already. So it may go a little cheaper to 472. ICP is at like 92%. So, I mean, it's good to buy now.
Yeah, like this would be a buy. The chart's obliterated. Not getting pumped. It's a good product, right? They're offering an actual product, not just hype.
But
And-
well, it's not going to go back to where it was $700, right? Never.
It might not. It might go to 100. Might go to 150. You never know, right? Like the point is to make money. So if you bought it $700, yeah, you might be screwed. I agree with that.
It's like that coin, or what's it called? Arbitron. People got wrecked. I know a lot of people got wrecked in that coin.
Oh yeah, dude.
Arbitron got
Everybody
wrecked
was
in
hyping
one day,
it.
hyping it, yeah.
Man.
It was a quick pump and dump. I sold it quickly, and through Dexus.
Look, people were freaking out over this coin. Look at it. It's obliterated. I mean, market cap stood at 1.5 bill. I don't even know how many billions they sold off, but yeah,
It
I
was
mean,
a high risk, high reward.
Yep. And well, again, it was hyped through what? It was hyped through initial investors. The people that got in early hyped it up, got everybody freaking out about it, and they got destroyed. This is why you don't follow these. Look, let this play out. And if you think ARB is great, hey, this is your time to buy.
Have a look at the optimism chart. Did the same.
Yep. Optimism did the same thing. And these are the things that people got to really pay attention to. But look, once optimism dumped, what happened?
It built.
It built. So don't think ARB is dead. Right? Don't think that, because you got to look at TVL. Again, we talked about it before, right? TVL is heavy. And ARB has some pretty good TVL. I will point that out.
She's just been born.
Yep.
Hey, Will, do you know of a way on Coin Market Cap there to separate coins by exchange and like platform, or I was trying to do it on CoinGecko and I couldn't find anything on Coin Market Cap. But I was trying. They have CoinGecko underneath the all cryptocurrencies. You actually have different options where you're supposed to be able to sort your coins by exchange and ecosystem.
Possibly DeFi Llama.
Yeah, I mean, you can. Are you just looking to find coins on a specific platform?
Yeah, I was gonna try to share some with find some on Coinbase and kind of make a.
Well, Coinbase, I think they have
kinda,
like a portfolio thing. So like here.
DeFi Llama will do it.
Cryptos. Yeah, I think this will probably take me to DeFi Llama. So right here, browse assets on Coinbase. So I don't know if there's a way to see them all, because there's a lot here. Look, looks like they have 9,177 different cryptos. So like, even if you were able to categorize this, there's so many cryptos on their platform, you wouldn't be able to get this on one page. You see what I'm saying?
Yeah.
But like, if you wanted to see what they had, you could easily scroll through here And
Yeah,
then
but what I was trying to do is separate them like, well, I guess you could separate. I see Web3 right there, but
Yeah.
I was thinking of trying to diversify just in Coinbase that I have, the different ecosystems, and I'm kind of spreading out, from a portfolio in Coinbase, and then have a separate portfolio for KuCoin.
Might have to
I
just
got some friends that only trade on Coinbase, and so I was going to try to share stuff with them as well.
yeah, you can do the problem is it's not as diverse as you think. So like if I wanted to go categories, for instance, or let's see, then I got all
No,
these
over to the right.
categories.
Over to the right, Will, there's a filters button.
Yeah,
All the way
yeah.
to the right. And then
I
you can
don't-
select what platform.
I don't think
so you
it's
can,
on
like,
here,
you can
though.
say, I only want Binance coins. You can select that and filter only Binance ecosystem.
Yeah,
Yeah,
it's
it's
gonna
on the
be
main
right
page.
here. Yeah. So like this right here, yeah, you could filter out
There you
certain
go.
things,
There you go. Okay.
and you can add more filters here, but like I think this would be kind of hard to, I guess not
Yeah.
too hard to navigate.
That's a little closer to what CoinGecko has.
Yeah, and then you got
Like I say, I think there's something wrong with their whenever I selected Coinbase
funny.
Exchange, it just wouldn't bring anything up.
Yeah, so we can go like cybersecurity platforms. You could say,
There you go.
I don't know if this one will do Coinbase specifically. No, it's more or less like Ethereum BNB. It looks like
That's your ecosystems and stuff. Yeah.
so Ethereum ecosystems. So we got crypto cybersecurity, Ethereum ecosystem, and then we could say DAG, POS, like whatever type of ecosystem you're looking for. I think this is like the base algorithm is like everything. And then you can say category, you can say DeFi, for instance, right? Like or whatever, which obviously that wouldn't fall into that, but yeah, so there's ways to filter through on here. It's just
Yeah, I'll play around with that.
yeah, just play with it. Like really, the only things I really look for is like categories because I think that these are just like categories they're gonna try and push in the next bull run. So that's why they're
Right.
adding them in here. So I watched the metaverse. I think a lot of this is just bullshit at the end of the day. It's just people playing on people's emotions and wanting to be in a metaverse and looking for low caps. But yeah, you could dig some gems out, right? You could dig some gems out of this. NFTs. Which again, I think, personally, a lot of that is just it's a scam. And I'm not saying the NFTs in general. I want to be very very descriptive in what I'm talking about. What I mean by like is there's a lot of NFTs in the space that are wash traded. And what I mean by wash traded is it's the same individual trading two different wallets and putting in prices and trying to pump the price themselves. Does that make sense?
Mm-hmm.
And they're trying to pretend like one entity bought a NFT that they bought for 25,000 or 2,000 or whatever for 250,000, and then the next person bought for like 500,000. But there's no way to track if that's the same individual flipping the same thing back and forth to try and push the price up on a specific NFT project. So you got to be really careful with narratives on NFTs, man. It's just so difficult to navigate that space of NFTs because there's a lot of dishonesty. Go ahead though.
Yeah, that's why I couldn't get into it because I just don't have the time to be researching that stuff, man. It's just too deep.
Yeah, it's difficult to tell if a project's true or if it's being wash traded.
Quite often the developers will do a first mint and they'll hand it out to the team like large amounts for nothing. And then if there's any benefits from the NFT, well, you're just going to get washed out anyway because you've already diluted.
Yeah, it's pretty crazy, man. That side of the space like you can get into it for sure. I know people see value in it, and that's okay. It's just that man, if there was ever a better way to launder money, it would be NFTs in the way that they're being used. And again, I know that may upset some people, but this is just the reality of things, guys. Like I'm not.
Hey, Will, what do you think of the gaming tokens like Gala? You think he got it?
I think Gala's got potential, but I think it's an overplayed asset. Like I think just too many people know about it. It's too out there, right?
Yeah. I know because as a gamer, you're a gamer. I know you're a gamer. I've seen your other channel.
Yeah, I play games and stuff like that. And again, I think that Man, I don't know. I think it's a difficult conversation when it comes to Gala because of
Yeah.
all the other areas they're trying to get into. Like I think the movie business is heavily unprofitable right now. I think that there's a lot of things going on that they're trying to get into that are just hard barriers to break into as a business. So we'll see at the end of the day.
Speaking of Gala, I'm sorry to interrupt.
You're good.
Cut you off at the end right there. But speaking of
No, go
Gala,
ahead.
is there any new news about Skid Row Records? I know kind of towards the end of the bull cycle or deep down into the bear, whenever it was, they said they were putting all their music on there, and Snoop Dogg and all had all his music on Gala or something like that. Ain't that right?
Death Row.
Yeah, that's right. Matt.
I think I heard something similar to that. I don't know. To be honest with you, I haven't been following development on Gala. I should be following, but I got too much TA to be doing. It makes
Yeah,
it
I need
hard
to
to
get
follow
back into it.
projects.
Dre just sold $250 million worth of masters. It'd be interesting to see where they're going.
Which one?
Dre
Oh, Dre.
just sold $250 million worth of his masters. It'd be
That's
interesting to
crazy.
see where they're going.
Hold on, what's it?
Hey, Will, you're holding Tether, right? You're still not touching USDC?
Yeah, I'm not too comfortable with the SEC going after him and stuff like that too. There's a lot of things being played there, so we'll see. I'm Tether's just been tried and true.
You still feel safe? You still feel safe with Tether?
Yeah, I mean I do. Again, it's just
Okay.
time in the market, right? Not timing. And time in the market, USDT's been there. So
All right, fair. Thanks.
Could I ask maybe a bit of an uncomfortable question?
Mhm.
Would you have a strategy for if there was, say, like a major world conflict just erupted, just a major global event happened?
Yeah.
Would you have a strategy that you would look toward in that event?
Yeah,
Okay.
like as far as like what I would be buying or where I think price would go.
Just what you think would be sort of the safest options, or just whatever advice.
It's always going to be the normal trades. It's going to be gold. It's going to be bonds. It's going to be a lot of those normal. Even defense, right? Defense is big.
Yeah.
And any type of catastrophic event, defense would be a massive rotation. That you
and
should
oil
get into
as
before
well.
they do. Oil too. Yep. Oil is definitely.
So all commodities,
food,
things
anything,
like that.
food, clothing, all your basics. Something I really pay
Gold
attention
probably
to.
push up as well.
Yep, gold will push up, but I think your bigger buys will be food because any type of
Maybe
catastrophic
something
event
grain?
would be food. What's that?
Something like grain. Do you think maybe something like grain?
Yeah, I mean you can get into grain, you can get into like Walmart or like anybody who sells produce, different things like that. So you're gonna see all of your your basic companies like Walmart, some of that have minimal, not minimal, but they have okay return on turnaround on product. Those that will actually increase because more people will become poor, and then they'll move to places that will save the money, and that'll be Walmart's and so on and so forth. So there's a lot of different sectors you can play in a downturn economy or depression, right? Really, what you're talking about, a catastrophic event would mean a depression. That would be the most even a war is not as catastrophic as a depression, in my opinion.
That's a money machine.
So, and it's going to be very difficult to create revenue in a depression, and you're going to have a really hard time being able to even invest, even if you wanted to, at that point.
Yeah.
Hey, Will, you think the US dollar is gonna get affected by Russia and China of signing the yuan?
No, I don't. And the reason for that is like you have to keep in mind for them to get off the dollar, what do they have to do? They have to sell the dollar, right? They give it back to us. They're kind of in a situation where they're kind of bound to the dollar, whether they want to be or not. It's so tied into their economies that, you know, they're kind of in a screwed situation. It's hard to explain, but the amount of debt to dollar that they have, those countries, like in our dollar, I don't think they'll be able to find enough gold to cover that if they were looking to translate or switch over.
Okay.
Does that make sense?
Yeah, it does.
Like these countries are just as in debt as the U.S. Every country I think is 2.5 debt to debt to GDP. The U.S. is 1.5 debt to GDP.
Or 5.
So
So China, like China, they owe they're in debt with the dollar, so they owe us money. as
yeah,
well, right?
they're so far in debt with a dollar they can't separate themselves. And if we were to come after them economically, China would be crushed.
That's why there's no war in Taiwan, right?
Yep. And that's why when people make the conversation, there will be repercussions if they did do that to their financial system. They know that. They rely on us very heavily to support their economy and because of the growth of their country. And it's not by the growth of their economy, by the growth of their GDP, it's by the growth of their people. They just have a substantial amount of people to support that would be unsustainable without the dollar being involved. Yeah, exactly. It goes against the whole dollarization that people sit there and talk about as a narrative. It's just I can't see a world where that happens. Not currently, not with the debt that the U.S. has enslaved all these countries to. Like you could say, oh well, they'll just separate themselves. Like to cut yourself off from the U.S. is certain death for most countries financially. That's why it's a difficult road to take. A lot of people, yeah, and again, Russia's doing well. I won't lie, they're doing very well from their lows. But I think that this comes back to bite them the direction that they took. Just later, right? Just later. I think that they floated this with gold, and I think later on this comes back and bites them much worse than what it had in the beginning. But dollar for me, it doesn't look bad. Like this was the expectation. You can see here I drew it out. Like maybe I should draw these a little cleaner, but just like I was looking for an M move here. Let's say they're buying a dollar back up. We get a full on rejection, come back to the lows, and we roll out. I think the dollar is looking to trade substantially higher. A lot of people keep on talking, oh, dollar week. Look, how long have I had the zone up? I've had the zone up since before even the run up. I've been showing you guys this on a regular basis. The box has not moved. It's stayed steady right there. This is on the weekly. Look at over here at the monthly. Again, we got a higher low, regardless of whether people want to acknowledge or not. We basically bounced right off the previous low body of price.
It always closes its gaps.
Yeah, it always closes its gaps. Exactly. That's what a dollar is really good about. It came back down, closed the gaps, and it looks like it wants to trade again. Now, the issue is do they go like this and hit? Because this was the expectation for the dollar for me. So if this happens, remember this conversation is that we come up to 108, we trade back down, maybe run sideways, and then trade up hard. That would mean what for stocks?
A drop in assets.
A drop in assets. This is what I'm thinking is going to occur. I really think it's going to occur. Yeah, it's still lining up perfectly. Nothing's
The
changed.
narrative at the moment is everything's decoupled from the dollar, but yeah.
Yeah. Now keep in mind the dollar rises in what type of environment?
Deflationary.
In an inflationary environment. There are also spikes in the dollar in deflationary environments. Those are bounces where inflation looks like it's ramping back up, but in reality, it's just a dead cat bounce, right? For inflation. And I'm expecting that push for that inflation looking like it's ramping back up to bring the dollar higher, only to really force the dollar down to the downside substantially.
So Will, I have a question. Will, how come the purchasing power, like when you purchase products in the U.S., the dollar weaker than Yeah, I was abroad like a month ago, and I seen the products like for them in Colombia is way cheaper. You know, the dollar's strong over there.
Yeah, the
Compared
dollar.
our domestic dollar here is weak.
Yeah, well, the dollar is strong over there because of their pricing power, right? We have more pricing power than they have. The dollar is still strong, and this is a conversation I had in one of the spaces too. And I think this is a smart way to always take the dollar. If the dollar is above $1, which is stronger, assets or the dollar?
The dollar.
No, right?
The dollar. The dollar.
No, not that.
So whenever the dollar is below $1, which is stronger, assets or the dollar?
So
Yes.
assets.
Assets. If you always look at it from that perspective, there's no fear to be had. Because which side of the market is the dollar trading on? It's trading on the stronger dollar right now.
Yes.
So it means
Assets.
that while people say assets are going to move, the dollar is not signaled that at all. Keep in mind, where did the dollar bounce? At $1. It bounced and ran right back up at $1. This means the second that people thought assets were going to move, a sell-off event happened in assets.
I think that's a life lesson right there.
Always remember that. Keep that in the back
Very
of your
good.
head when you're trading. That's why when people are saying the dollar's weak, it's like, it's not below $1. It's not weak. It's only weak when it's below $1. If the dollar goes below $1, hey, assets might move, guys. I'm going to tell you that right here. If the dollar goes below $1 and starts moving towards the downside, assets might move. But as long as it remains above $1, dollar has more strength.
Just look at 2020, right?
Yep, same thing. So we have this over here. We look at 2020. Who had more strength in 2020?
Assets.
Assets.
Yeah.
What happened when we had that COVID event? What happened to the dollar?
It just worked up there, that's all.
It went up, right?
It wicked up and it got above $1. And then what did they do? What did they do here? They injected money, right? Which did what to the dollar?
It
Diluted it.
Diluted it and brought it back down in the balance, and assets became the dominant space, and then assets reigned.
Manipulation.
Pure manipulation. And then once we got back down to the low range of 2018, what happened to the dollar?
Bounced off support.
Held support all through 2021. And then mid-range, just like the bonds, right? Just like the bonds, once it got above support, just like the bonds, boom. And what happened to assets? What happened to assets right here?
Tanked.
They tanked, right? What happened to assets since October? They bid, they bought,
Rallied. Yeah.
they rallied. What do we see right here? Looks like a sell-off event to me. And then what do we get? We got a little more buying. So basically what we've got in the dollar range above support is consolidation. So until consolidation breaks, we can't make a decisive decision whether it's up or down. But we are on the upside for the dollar and the downside for assets as long as we remain above $1.
Right on support.
Right on support. And they trick people. They trick people in this range. I want you to understand that by bringing the dollar Okay. Bringing the dollar below previous support, but bouncing it right on. Sorry, excuse me. Right on what?
Right on the dollar.
Right on the dollar.
0.
100.8.
So you could consider another test of the dollar range and not really be considered a triple test yet,
Right.
technically.
I would consider, and this is what I've been considering because I accepted the move up here as being the true move and this to be FOMO. So what that means is that there was a mass sell-off event here, and this was probably all retail. And then the buy-up was all institution. And now we're getting the bid again as far as over here from retail, buy-up institution. And what that's telling me is that they're not willing to give up on the narrative that the market is bearish.
So if the market's at $1, that's essentially the inflection point of the zero-sum game.
Yes. The inflection is either down or up. As long as you remain above, you remain bearish. As long as you remain below, you remain bullish.
Well, that's easy.
Don't fight the dollar, just like you don't fight the Fed. Well, a lot of people don't get this, right?
You're a master, Will.
Yeah, you break it down. It's simple. It's really simple.
They don't understand the difference. Go ahead.
Isn't that what the BRICS is trying to do, though? What we were discussing earlier, right? Right?
What's that?
About the BRICS nations,
Yeah.
and now they're going to use their other currencies between their countries other than the dollar.
I mean, they can. Again, we discussed that, but that doesn't mean that their debt will go away, right? If they want to trade with the US. So the only country that can't trade with the US right now is Russia. So the other countries will still have to deal with us.
And I was also listening to how we could, as a country, could eventually cut off this side of the world and trade amongst ourselves between Mexico, South America, North America.
No, I've heard that narrative, but I think Europe will always remain a US ally. I don't think they'll ever be a part of the BRICS. Could they war with them? For sure. But like they don't agree with them. Does that make sense?
But well, that was a big mistake. Well, I don't know. People have their own opinions about Brexit, but right now they're going through shortage of food, and they can't go back to the Europe.
Well, what he's talking about is BRICS. It's something different. It's an alliance between the countries. What you're talking about is Brexit. But yeah, Brexit is a separate issue in itself. It's just something that they got to deal with. I think Europe's made a lot of bad policy decisions. I think even the 50 basis point hike was too bearish. And I think that's going to come back to bite them. I think they should have followed the US into the 25 basis point hike. But I think all countries pretty much on this interest rate hike, we'll say excitement. I think they're all over tightening. I think every country's over tightening. It's pretty bad. Go ahead, Eddie.
Well, I would disagree a little bit on Europe going too hard. Don't you want it to go harder, faster to get it over with and then start again?
Well, again, it's pros and cons, right? I agree. I think going too hard and just breaking shit the way it needs to be done, it gives a faster response and a faster return. So I agree with you on the aspect that it's better in the amount of time that they'll have to deal with it. I think it's bad in the short term, right?
Right. They did it at the beginning and of the problems when they started cutting rates. It would have saved the economy was in better shape. It would have saved a lot of headache. I believe.
Yeah. Exactly.
Took too long.
Yeah, they took too long to respond, just like a lot of other countries, which will lead into over tightening. When you don't respond appropriately because you think something or you feel something, you miss the trade, right? And most of these economies and economists and Feds have missed the trade. They sat on it too long to make decisions. Now they've moved into the situation of over tightening, And the way you're talking about with the over tightening, Danny, I think you're right in one aspect, but in the other aspect, I think if we were talking about the same way I was discussing it previously when I told you about this too, and everybody else, is they would have come out in 5% right off the bat and crushed these markets immediately. That would have sustained any type of growth immediately. It would have halted all things. Yes, we would have had a big crash, but we would have had a faster recovery.
Exactly. But now we're in stagflation now.
But now we created a situation where this will now play out longer, and people are just being stupid and saying, and I say that, you know, in response to, like, with the utmost respect of all people, but, and it sounds like I'm being disrespectful, but to sit there and state that, oh, we can just live with 4% inflation is just stupidity. If you live with 4% inflation, and really, I think the Fed's goal is really 0. It's just that 2% is just the window they can play with, right? To live with 4%, you're going to inflate pretty heavily off of that, because it's going to be heavily. You see the manipulation people do nowadays with algorithms and everything else. They manipulate the price on markets. They try and get markets to move in a direction that they want it to. They get the market over FOMOed and then take all the money once the inflation sets in. So. Yeah, it could be, Miguel, and it could be longer dated than what people think too. So it might not even come this year. Like, maybe the real tail end of this comes out like a year or two later. And that's what I want people to understand. It's like, this tail end doesn't have to play right now. They can literally just ride this thing out, and then, literally 2025, 2026, boom, big lay down. And we just continue to play the chop for the next couple of years in assets until that happens. This has been a cycle that's always kind of done these type of things, big drop down, right? You got this long consolidation up. This is where they basically double top high, and then the market just pukes itself out. Now, this is a chart I wanted to bring up too. So what event do you think happened here on this date?
Is that the .com?
Nope. What happened here? Anybody know? November of
COVID?
2000. Nope. November 2000.
Black no.
Black what?
Oh, disregard.
He's gonna say Black Swan, I think, but
Yeah, no.
nobody knows.
Wait, 2020, then we have
Is
that
that
small
Y2K?
Well, Y2K occurred over here. What happened here on this date right here specifically?
I was 15 years old. Sorry.
I don't know.
Oh,
The blackout?
Nope.
This is a trick question.
I'll give you a hint. It involves the Fed. What happened here?
I don't know. You got me.
Did they cut interest rates?
This was when they paused interest rates. Now, what happened after that?
Then a recession came.
This
I'm not 11, right?
this is when they cut interest rates. Do you see anything here?
Pain.
This right here, what happened here?
They cut interest rates
Down?
again.
Nope. What happened right here?
Well, 08 is the housing crisis, right?
Yeah, but that's this involves the Fed again. What happened here?
Would that be pause again?
Pause again,
Well,
cut again.
okay, that's
You see a pattern?
So every time they cut rates, it drops.
Here's your pause to your bottom. What do you got there?
931 days.
Okay, what's your percentage drop?
44.6.
Here's your pause to your bottom. What do you got there?
52.77.
Let's say bulls are right. We get a pause right here. And
In
let's
June.
say we get a cut somewheres over here. Let's go and let's guesstimate that drop real quick. So we're right about, oh no, sorry, a little high there, a little high. We don't want to be too high. No, we'll get a little bit of fat. We'll be higher. We'll say the pause happened while price is way up here in the 4100s. So we'll give it a modest 30% downturn. What price is that?
28.42, but that's modest.
30%.
That's a 30% drop. So let's say they do a 40% drop. What price is that?
2453.
How well do you think the economy will be if that happens?
So the 50% will kind of align with that bearish trend on the bottom, huh?
Good. Very well could. Now this is a theory. This is not reality, but it's a possibility that you should not ignore if it happened. Right? So if that were to occur historically, right? We're talking historically. We're not talking about hope or money injection or COVID or yada yada black swan. We're talking about numbers and charts. Historically, what happens after a pivot to a cut?
Historically, the market drops.
This is not a one-off event. It's every single time. Do you know what the interest rate was here?
Is it in
Anybody?
the teen?
Nope.
I can't see the date. What date is it?
So this is November of 2000. What was the interest rate?
Wasn't much, was it?
5.25.
high.
Do you know what the interest rate was here?
I think it was 8% now.
Nope, guess. 5.25. You know what the
Actually-
interest rate is right here?
Insane.
5.1.
Oh,
We're in that range where shit breaks. The events occurred after the interest rate stayed elevated. I want you guys to understand that this ain't about calling a black swan event. It's about these pressures on the markets create problems.
Did it just change to 5.25 at that point? Or was it all along before it dipped?
Well, it was up for like a couple months, right? Like it's meeting to meeting, they're increasing. So increasing, look, you can kind of see where they're starting to increase because you start to see that round top, right? Increase, 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 hold.
Right.
And then market freaks out, cut, market's still falling because the market's still feeling the effects of what happened from the event.
well, you get
Is it still 5.25 when it dips? Like when it keeps going down?
No,
is it
They are cutting from here.
Okay.
They are cutting interest rates there.
It's
Well,
like
what's the-
that when they cut the rate, there's like a little pump and then it just keeps going down.
Yep. You get the big puke, you get the big pump where everybody's like, yeah, got it. And then a bigger drop.
Is that the 2 years you're talking about, Will, when it's that big pump?
Nope. This
goes up
is-
for the full run and then drops again. I'm talking about 2025, 26, 27.
Yeah, so this is going from 00 all the way into 02. This is 2 years.
Gotcha. Okay.
But when it drops, it's still at 5.25. Like it stays at
No,
5.5.
we're basically at no rates here.
No, but when it starts to dip, is it still at 5.25? Is there something that triggers that?
Oh
Is it
yeah.
just
So when it starts to something breaks, right? Something breaks. We're still at 5.25. Something breaks, and then they start cutting on the event that broke.
And whatever breaks, it could be a number of things. Like
You got housing
Mhm.
crisis over here. We had .com blackout, all the other stuff over here.
Right.
Like a lot of things
So-
happen in these zones.
So the Lehman Brothers filed for bankruptcy on September 15th, 2008.
So September 15, 2008, right here, right when cuts started, right before cuts started, right
That
before
was
cuts
the
started.
trigger. That was
Yep.
the trigger for the drop, basically.
That was the trigger for the drop. So they held rates elevated, market continued in the downtrend, and then Lehman Brothers, and then boom, 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 boom.
So all of this Silicon Valley Bank, FTX, those things aren't as impactful as Lehman Brothers, I guess. Those are like kind of a drop in
Nowhere's
the
near
bucket.
at the time.
Mhm.
Lehman Brothers was like the place.
Well, you
All
see
right.
how quick it happened too in 08 compared to 2000. 08 was the housing market bubble as well. So there was a big buildup
Yeah, there was a lot of
ahead of
problems in
that.
08.
So
Yeah.
yeah, I mean, I considered that something that happened fairly quickly, but what's coming, I don't know. Seems like they're playing the long game a little bit. I'm new at this stuff. I'm just feeling it out, but
No, you're good. If you look here, that's a long time period to hold that price,
yeah.
right? And
Well,
if you look
comparing to
here,
08,
it's well, the upper zones tend to hold. Like we got what? How many days? 378 days, right? Full year. If we come over here and we look from upper end, and really we could take it from the other end, but we'll just take it from the farther end. Again, you're looking at 350 days, right? When we pause, which if they're right, we'll pause here in probably May, June, whatever, right? We'll basically have, again, if we go to 350, somewhere's over here, right,
Right
in
before the halving.
2024, and then boom, big event down, market drops, consolidates, and then we start to move off of that, just like over here. Yeah, if I were to take this like from the Bitcoin halving,
Here goes past it.
right here. Well, this is on SPY, right? So let's look at Bitcoin specifically and see, because this is probably basing off this time span, a bunch of weird stuff, but let's go up Bitcoin specifically. So we're looking at May of 2024 as the halving. So we go back to SPY and we put a vertical on May of 2024.
Yeah, it lines up. That's crazy.
And then we run across. Yeah, that's 428 days. We would drop right before that,
Yep, and blow.
and then go out of that. That's crazy.
That's
Wow.
big money. Yeah.
Yeah, that's
Heck yeah,
pretty
man.
nuts. But yeah, that's again, it's just me looking at history, guys. Like I don't make stuff up. Like I'm showing you guys over here, like how it's played out historically, right? And I'm just comparing previous cycles to current, and I'm seeing this turning out really bad, right? Because again, cuts are this is hold all the way into cuts. We start getting cuts here because there's a big catastrophic event that drops the market. The market consolidates before the halving of Bitcoin and rolls out. It's weird. It's a coincidence that all these things line up. Again, I'm not a tinfoil hat person, but I mean the math's there.
Hey, it's all about probabilities, right? I just finished listening to the audiobook Trading in the Zone, and it's freaking awesome, man. It really got me into the mindset of I'm fine either way. You know what I mean?
Yep.
Just look at the probabilities.
That's all it is. Yeah, exactly. Look at the numbers, look at the probabilities, understand your probabilities in both directions, and take the most likely route of probabilities. That's all it is. So again, I think I haven't read the book that he's talking about, but that's how I look at things too. I look at things from a probabilistic standpoint.
Is
right?
there a book,
It's on
is there a
YouTube.
book you recommend? That's like the best trading book.
Maybe just post it in Discord when you get it in like general chat or something like that. The YouTube that you were watching.
Yeah.
I gotta take off though, guys. I gotta make food and stuff like that. But you know, this has been a productive, I think, meeting for the most part. We talked about a lot of things. We talked about the dollar and how you guys could invert that. We talked about SPY possibilities on that, kind of what happens prior to a pause to it going into a pivot, aka cut rates. We talked about the different charts as far as what we see going on. We talked about the different markets, banks. We talked about credit lines. We talked about a lot of things here. So just keep all those in the back of your mind. Again, don't get too hyped on the market. We discussed why. We discussed what the possibilities are. We discussed total, right? Keep total in mind, and where you're at on the total chart, and then take your positions based off that. All right.
Well,
That's amazing, Will.
Thanks,
Will, is
man.
there a PA
Thanks,
book
Will.
you recommend?
No problem. As far as I'll look through some that kind of look in that scenario, and I'll try and throw them in the Discord for you guys.
Okay, Will, that's fine. Thanks.
Take care.
Okay.
of
All
it.
right,
You the
guys.
man, Will.
Appreciate
Oh,
you.
senor,
Yeah.
do you plan to
Thanks,
do one
Will.
on Monday? A meeting or until next Saturday?
I'll see you on Monday. I got to kind of play it by ear. I have some stuff kind of going on this Monday, but
I think anything is
I will
gonna
try.
change.
Yeah, it's the market should stay relatively in the direction we've been watching, just sideways chop.
And it will take a little while to digest this one again.
Yeah. I'll post this video. Just like go back and watch it if you guys start to feel hype again.
Gracias.
Love you, Will.
Yeah, I'll see you
Hey,
guys.
Will, good night, Will.
Yeah.
All right,
see ya.
see you, Will.